The markets are essentially priced for Fed perfection.
The market has already gotten to the point where you're likely to cut 2 times this year.
The concern is if they move too quickly, the expectational set in the market could get ahead of themselves.
I'm a little bit more cautious in the near term because I'm seeing evidence of investor over-optimism.
The most dangerous time for the economy is usually when the Federal Reserve decides they're going to help it.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
Let's get you to the weekend. What a long week. From New York City this morning, good morning for our audience worldwide. Bloomberg Surveillance starts right now with equity futures on the S&P 500 positive by 0.1%. Here is your day ahead as Wall Street kicks off earnings season. A little bit later this hour, we get numbers from the likes of JP Morgan, then it's Wells Fargo, then it's Citi. Later on this morning, another read on inflation with PPI data, then 10 a.m. Eastern Time, UMich consumer sentiment. We have to begin this morning, though. I have never seen people so happy with a drawdown on the S&P 500 by close to 1%. Have you?
Everyone's been praying for this broadening out, and that was what you got yesterday. You saw a real big performance from the equal weight. You saw a real big performance from small caps. Mag 7 fell the most going back to October 2022. People are cheering this, but you asked a question offline, and I'm going to cheat, and I'm going to say, you asked the question, how many people are in this broadening out trade and are not just celebrating it on paper?
They were certainly chasing it yesterday. Let's just get to that graphic again. Just look at these moves in yesterday's session. The move on the NASDAQ, down hard. On the NASDAQ 100 by more than 2.2%. On the Russell up by 3.6%. Small caps outperforming the NASDAQ 100 by the most since November 2020. You've posed the question, how many people today think something material has changed after the data and the price action we got yesterday?
That's a great question. We did have the 2-year yield fall the most since January. Suddenly September very much on the table with the likes of Mary Daly as well as Austin Goolsbee of the Federal Reserve coming out and giving ammunition to this, saying, if we were looking for confidence, guess what? We kind of got it. So it gives the sense that the Fed is preparing to cut rates. Now the question is, will the data hang in there enough, like the jobless claims suggested, to make it a good rate cut, to make it just a mid-cycle adjustment that allows some of the more leveraged companies to actually do better, given that borrowing costs ostensibly are heading lower?
Going into the number yesterday, you asked Michael McKee a question. What's the most important number here? Is it CPI or is it jobless claims? We were talking about this. I don't think that CPI looks as good without that jobless claims number. That jobless claims number sort of cemented this idea that we can get back to 2% and we don't need to worry about the labour market too much. But another question for this morning, that goes against the grain of the last couple of weeks. Was claims yesterday an outlier? Or was that actually a decent read on where this labour market is? Is that the kind of strength that this Federal Reserve, this chairman, thinks we have?
You know, it's a great point, and it's ironic that as we were talking about the earnings for the likes of Delta and Pepsi and Conagra and how disappointing they were and the pushback that consumers are feeling with respect to pricing on even some of the best performing industries, I'm thinking travel, we got a better than expected jobs print. And everyone said, this is Goldilocks. Is it Goldilocks? And is the margin compression we're seeing at a lot of companies simply a factor of what we're seeing with inflation coming down and people said you would see margin compression? Or is this really a sign that things are moving more quickly than a lot of the headline data can reflect?
So this is the price action, and we'll get more data later. We have to talk about the politics as well. I'm sure you sat through it. It started about 7:30 Eastern Time. It was a 7-minute address from the President of the United States. Q&A lasted about 50 minutes. Lisa, I think we're both going to agree on this. For some, it wasn't bad enough to drop out. For others, it wasn't good enough to stay in. And I'm not sure that you can put the toothpaste back in a tube after the last couple of weeks in this country.
Well, that's the key point. How much can you change this? And honestly, Joe Biden nodded to that last night. He said, you know, it's never going to be enough for some people. They're just going to say, wait another month, wait another day, see what else happens. Look, I'm fine. The key issue is there were a couple of gaffes. People are going to focus on that. I'm less focused on exactly that. I'm more looking at just his demeanor, the fact that he couldn't really answer how well are you going to be able to do this in 4 years, and a lot of questions just going forward about his energy state, and frankly, quickly deteriorating levels that we don't feel like have accurately been reflected by people who are closest to him.
Let's park the gaffes. We'll talk more about the gaffes a little bit later. Let's just leave that there. That's dominating the headlines. I get it. And we will play some of that for you in about 10 minutes' time. He opened the door yesterday to something new. There was some humility there that we didn't see in the last couple of weeks. He opened the door to the idea that it's not just him that can be the former president. And if you think about the whole reason he's been running for a long, long time, him and the people around him, the whole argument here was that he was the only one that could beat the former President Donald Trump. I think that was the first time we've actually heard an acknowledgement that others can too. And I wonder how much oxygen's going to sort of like breathe some life into that story over the next couple of days.
Well, and the oxygen is just waiting to be had, given the fact that we're getting reports that his campaign is examining what a matchup between Kamala Harris and Donald Trump would look like, that it's secretly polling people to get a sense of what this is. We don't know why. Maybe it's so he can come out and say, actually, I'm the only person who can beat Donald Trump. But there's almost seemed like a tacit admission that they were open to looking at what is going on in the polling and what is the best opportunity to beat the former president. Honestly, people are going to speculate a lot. People are going to talk about the gaffes. To me, last night was sad. And really, it goes to this question that we all have when dealing with aging relatives or friends, when they can't have the same kinds of energy and performance as they have in the past. It is difficult to say. It is difficult to know how to go forward. And you can feel the torture that a lot of people in his party feel right now.
You can, and I'm sure you could feel the torture in this market yesterday if you weren't long small caps. Do you like that transition?
That was
okay,
good.
Let's move on. Equity futures on the S&P 500 firmer here by 0.1%. It's a little bit of a lift to go into the weekend. Yields higher by 2 basis points on a 10-year yesterday post CPI. You saw that break of 420. Back above it now on a 10-year at 422.75. Coming up this hour, we'll catch up with John Stoltzfus of Oppenheimer on a mega rotation out of mega caps. Isaac Boltanksy of BTIG with new calls for President Joe Biden to step aside, and Gerard Cassidy of RBC as Wall Street kicks off earnings season. We begin with our top story. The 7-day winning streak for the S&P 500 coming to a close with a big move out of big tech. John Stoltzfus of Oppenheimer writing this: near-term volatility could continue to present opportunities for investors to catch babies that get thrown out with the bathwater in periods of downdrafts, as the market digests levels of uncertainty that are not uncommon in times of transition in monetary policy. John joins us now for more. John, we'll get into the new price target on the S&P 500 in just a moment. I think we all want your reaction to the price action yesterday in response to the data we got at 8:30 Eastern Time.
Well, Jonathan, I think it was most certainly the market celebrating the thought that the data that came out would give Jerome Powell the opportunity to cut earlier than after the election. So it looks more like a September when the futures went from 70 to 90 some percent in terms of the chance that we'll get a rate cut. I think it's a little bit overdone in its anticipation of that. I think the Fed's independence is an issue that the Fed will need to think of ahead of an election before it does that. But it does seem that one thing for sure at the moment, not with any other data crossing the transom yet that would be contrary to that, it does look like the Fed really is getting very near the end of this Fed funds hike cycle. And the market, of course, likes that, and doing it without a recession.
John, you've always talked about the importance of earnings, though. If we can park the data from yesterday, let's pretend it didn't happen. I know that's a big ask. Let's pretend the news conference yesterday didn't happen either, and let's pretend bank earnings don't come out later this morning. Okay, that's a long list. I know. It's a long list, granted. But the only thing, apart from all that we'd be talking about this morning, John, would be the numbers from Delta and the numbers from Pepsi. It wasn't a great start to earnings season. I just wonder how you thought about that as those numbers dropped yesterday.
Well, without getting too specific on the names, let's just put it this way. Anyone who flies on a plane knows that capacity has been, on commercial aircraft, has been in the back end of the plane. There's more seats available than there were before. Up front, it's tough to get a seat. It's tough to get an upgrade because both business and the everyday fun traveler are flying up front. But the idea is here, not surprising on the airline and related to the soft drink and snacks maker, it's a staples stock. It's good dividends, but of course it's got all these drugs that are coming out that kill people's appetites. And the question is, are you still going to, down a bag of potato chips or another brand name, as you would before? And I think that's the issue.
Wait, hold on a second, John.
It's idiosyncratic.
I'm so sorry.
Pardon?
But, John, I have to break in there. Are you saying that some of the weakness that we might be seeing in the likes of Pepsi and Conagra, for that matter, is because of Ozempic?
I think very well. I don't know about Conagra, but I would say related to Pepsi, it most certainly has been a question that has been raised by components of the market moving forward. Personally, I feel that, I don't think everybody is going to do these drugs, and I think Pepsi will probably do fairly well, but I'll leave that to our analysts to speak with you about that, because I manage money and the firm doesn't like me getting in the weeds related to individual stocks, regrettably.
All right. Well, let's talk about the overall index. You did recently upgrade your year-end forecast from 5,500 to 5,900, talking about the resilience overall in some of the AI-related names, this trend that's kind of fueling a lot of the optimism right now. I'm just curious whether some of the recent price action and the knee-jerk reaction of markets to the prospect of a rate cut make you question that?
No, they actually don't. I think because what we have happening in technology is both cyclical and secular in nature. It looks like some kind of a watershed, as was the introduction of the PC and later on the laptop and later on the smartphones into technology beyond the point of the early internet, and not tech bubbly, let's put it that way. And if you look at the declines yesterday, I think with the S&P, you had real estate and utes and materials were the top performers, and at the bottom were communication services and information technology. But if you consider the fact that tech is still, after yesterday, up 32% year to date, and communication services is up 27%, it's a haircut, not a rout. It's just the market is broadening. Stocks appeal across the sectors. There's a realization that among the 9 other sectors, there's lots of what I would call AI proxies in terms of companies that can utilize the AI that exists today, the AI that's coming down the pike, and to become more efficient. And that efficiency goes to both companies, and it also goes to the consumer. So if business and the consumer are using this is a pretty big thing. But I do believe that people are recognizing now, after from the start of this year, this narrow rally among 7 stocks or so. The reality is, there's financials, there's consumer discretionary, which has been fairly well ignored, even though it's had double-digit earnings last reporting season. It's off to a pretty good start right now. All in all, when you look at it, it's with the prospects of the industrials picking up with infrastructure spend and reshoring and friendshoring and all the stuff. This is a very interesting time, and it should be good for stock prices because it'll drive revenue and it will drive profits.
Hey, John, wonderful to get in touch with you this morning. Thank you, sir. John Stoltzfus there of Oppenheimer on a morning where small caps are outperforming. Once again, the S&P 500 firmer by 0.1%. The outperformance once more, Lisa, on a Russell.
Lots of fish in the sea. That's kind of what you keep hearing, Now we're looking around and things are looking not so bad. And that's basically what we've been hearing from a lot of people. Let's just be honest about that. Key question is, can the index continue to climb higher without the robust participation of some of the high flyers, as many people have been calling them, for the remainder of the year? We heard from John, yes, because of some of these other names. And I guess those we're going to test maybe with financials later this morning.
It's quite a move yesterday to see the S&P down by almost 1% at the close and have more than 400 or just a little bit less than 400 members of the S&P 500 higher on the day.
It highlights just how dominant those Magnificent Seven are. And some of the idiosyncratic stories. I know later we're going to talk about Tesla, but Tesla was down more than 8%. That's a pretty big component of the index. You start looking at this, and that was more fundamental.
Ed Ludlow, the reporter behind some of those moves, is going to join us a little bit later. Let's get you an update on stories elsewhere with your Bloomberg brief. Here's Danny Berger. Hey, Danny.
Hey, John. More trouble for Boeing, warning some 737 MAX customers that deliveries could be further delayed for 2025 and 26. Sources tell Bloomberg the plane maker said timelines may slip by 3 to 6 months, on top of already late handovers. Just another reminder that Boeing's production of its cash cow model faces a long road to recovery. And I'll give you a little teaser for Ed Ludlow's story on Tesla. The shares are down another 1.8% in the pre-market trade. The EV maker is postponing the long-awaited unveiling of its robo-taxi by 2 months from August until October. Sources tell Bloomberg that the company is pushing back the date to allow its teams more time to build additional prototypes. Optimism about the event had contributed to an 11-day streak of gains, which ultimately added $257 billion to the company's market cap. That was before shares dropped on Thursday by the most since January. And the late Silvio Berlusconi will join the likes of Leonardo da Vinci and Marco Polo in having one of Italy's airports named after him. Milan's Malpensa Airport will reportedly be renamed for the billionaire-turned-politician who died last year. Berlusconi was a flamboyant media mogul. His reign as Italy's longest-serving post-war prime minister was plagued by sex scandals and corruption allegations. That announcement upset many Italians. Milan's mayor called it crazy, and more than 120,000 people signed a petition demanding a reversal of that decision. And that's your Bloomberg Brief. John.
Danny, thank you. Were they all Inter Milan fans? That's all we want to know.
Oh, yeah.
Okay.
I like that.
The AC Milan half of the city, probably not too fussed with this.
Well, how do you feel about it, John?
I had a very, very different view of him. Of course, much more controversial later on, but when he took over our club in the 1980s, you grew up with a different view of Silvio Berlusconi and all the success your football team had.
I immediately just...
It's like ask a Chelsea fan what they think of Roman Abramovich.
Okay.
You know? They'll have a different view to everyone else.
All I can say is I immediately Googled what his favorite food was to see what the airport would look like.
Oh, right. What was it?
I haven't found it yet.
Okay, keep
Manzo
looking.
alla California.
Okay, you keep looking. Up next on the programme, mistaking your allies for enemies.
Now I want to hand it over to the President of Ukraine, ladies and gentlemen, President Putin. President Putin. He's going to beat President Putin. President Zelensky.
The conversation's up next, live from New York this morning. Good morning. Live from New York City, welcome to the programme. Equity futures on the S&P 500 firmer hit by just 0.1%. The outperformance once again on the small caps, just like yesterday. Let's see if that sticks. Under surveillance this morning, mistaking your allies for enemies.
Now I want to hand it over to the President of Ukraine, who has as much courage as he has determination. Ladies and gentlemen, President Putin. President Putin. He's going to beat President Putin. President Zelensky.
President Biden mistakenly introducing Ukraine's leader as Vladimir Putin before dropping the ball straight out of the gate in the news conference that followed.
Look, I wouldn't have picked Vice President Trump to be vice president, but I think she's not qualified to be president.
Those gaffes overshadowing a near 1 hour news conference where he demonstrated a decent command over complex topics. For some, it was never going to be enough. Almost immediately after the news conference ended, at least 3 more House Democrats joined the growing list of lawmakers calling on Biden to step aside. Anne-Marie joins us now from Washington. AMH, you were in the room. How did they react when those gaffes dropped?
Well, first off, we should note that he pretty much lost the news cycle before we even stepped into the press conference because he introduced President Volodymyr Zelensky as President Putin at his prior event. So already you can sense this was going to be incredibly tense, and he really needed to outperform. And then his first answer, he mixed up his vice president, Kamala Harris, calling her Vice President Trump. The room was silent, but you could see there was a few sighs. People were trying to hold in their gasps, and the faces on people clearly said, ooh. And then they started sitting on basically the edge of their seat to see whether or not he was going to make another gaffe. So that completely overshadowed the fact that actually when it came to some complex issues, like you mentioned, when he was talking about Gaza, China, Ukraine, he had a good handle on the material. And it wasn't like the debate where he was losing some train of thought. But these gaffes is what has taken off, not just on social media, but also just a few moments ago, about a 5-minute segment on Russia TV, a composition of all of President Biden's gaffes. And that is why it wasn't enough to stem the bleeding, but it was enough, his performance, to give him a few more weeks. And let's see how he performs Monday evening when he sits down with NBC.
Anne-Marie, stay close. Let's continue the conversation with Isaac Boltanksy of BTIG. Isaac, I don't know about you, but my sense of that news conference, that was the first time in the last couple of weeks that I think the sitting president showed some humility. Just this idea that he was somewhat open, just a little bit, relatively speaking, to being replaced. What was your sense of things?
Yeah, look, I mean, if we start with the overarching view of last night, it was undeniably a Rorschach test. Everyone got a little something of what they wanted from last night, right? We can focus on the gaffes, and that's what the folks who want him to step aside are going to highlight. But he did have, as Anne-Marie said, an impressive command of the issues. And I think that's what you're going to hear from his supporters. And so, at least for me, the way that I think about this right now is he has been in survival mode. It's been about survive and advance. And last night let him advance. And we're going to advance now to next week, where we've got to focus on how he's going to do at some of these press events, but also during this interview on Monday evening.
Isaac, as this progresses and as he buys time week by week, how much do you think this gives the chances of Donald Trump winning the presidency get bigger and bigger and bigger?
Yeah, look, I think that Trump was the favorite before the debate, and he is even more so now. And I firmly believe that the Trump campaign is more than happy to let the Biden camp fight it out with elements of its own party. They love this intra-party fighting, and they would be happy if that would continue for the foreseeable future. I wouldn't be surprised if they would like this to overtake even the headlines from their convention that's coming up next week. So look, my message to clients here has been pretty straightforward. Trump was the favorite before this. Trump is the favorite after this. But to me, what's happened over the past few weeks really underscores the likelihood now of the increased likelihood of a GOP sweep, because I firmly believe the House is going to go whichever way the White House goes. And I think that margin is going to continue to increase if Democrats are squabbling over who's atop the ticket.
Isaac, there's some reporting that Joe Biden's campaign is quietly polling the public to see how Kamala Harris fares against Donald Trump. What do you make of that reporting?
I think part of it is the humility that John talked about, right? I think that he was open to that idea that he had a terrible debate, and that ultimately the goal here is to beat Donald Trump for the Democrats. I think that one of the things that didn't get as much coverage because we were all just dealing with the fallout from the debate was his follow-up where he said that if he lost, he would be okay with it. Democrats have to square the circle there, right? Either Trump represents a existential threat to democracy and needs to be stopped at all cost, or it's okay, we can lose the election, right? And I think that's something that we're trying to see Democrats grapple with in the wake of the debate.
Isaac, we keep coming back to pressure points, and there's three of them really: party officials, donors, polls. Of those three pressure points right now, what do you think is going to be the greatest for this president?
Yeah, look, I think there is a committee to unelect the president. I think that committee is growing by the day. It grew last night. For me, I think that committee's main cudgel, their main way to influence the debate is going to be polls. And we're going to have to continue living and breathing with every single poll. And to me, that's number one. Number two is, look, the president in some ways is going to be Sisyphus, right? He's going to have to push this boulder up the hill every single time he walks out of 1600 Pennsylvania Avenue. And every single gaffe he makes when he's out in public is going to be one that we analyze to the hilt. Because, look, it's no longer, your crazy Uncle Joe, right? We're talking about cognitive capacity to be president now and to do so for another 4 years after this. So, look, I'm watching the polls, of course, that's number one. But number two is every single outing he has is now going to be like the Super Bowl for him.
Isaac Boltanksy of BTIG. Isaac, thank you, sir. Yesterday was a difficult day for the president. Not the gaffes, not the news conference, the lead up to it. Report after report, New York Times, some Biden advisors discussing how to convince him to step aside. The Biden campaign testing Kamala Harris's strength versus Trump. You alluded to that. Politico, Obama was in touch with Clooney before the op-ed came out. Didn't advise him, but didn't object either. It was headline after headline, just relentless over the last 24 hours.
Which maybe was the reason why, at least for me, I was interested in some of the jabs that he had against his own staff during last night's press conference. They just keep adding things to my schedule. They talk a lot. How much he's sort of pushing back against this.
Credit where it's due, joke of the night. Good golf joke in that news conference. Writing down the score before you've hit the ball.
That was pretty good.
That was a pretty decent golf joke. We'll give him that. From New York City this morning, good morning. Live from New York, welcome to the programme. Equity futures on the S&P 500 firmer by almost 0.1%. The standout, though, once again, check out the Russell. The small caps up another 0.75%. Lisa, after a mega gain in yesterday's session.
To me, okay, it was the best performance going back to December. The equal weight S&P 500 versus the market cap weight had the biggest divergence going back to 2020. This was a seismic day and shifting back to broadening. You asked the right question. How long can this last? And how long is this going to be a positive, given how many people are hinged to those Magnificent Seven?
How durable is this move? To state the obvious, I guess we're going to find out. But ultimately, to see people jump on the bandwagon yesterday was pretty phenomenal, wasn't it? This is it. I'm so happy. And I'm sitting there thinking, a lot of people just own the S&P 500, right? They're not going to take much comfort from you telling them that almost 400 members were up, even though we're sort of down by almost 1%.
So there are two interpretations, and you are correct. One is, okay, maybe there's something amiss here that people aren't understanding how the index can actually keep climbing if you don't have the participation of the Magnificent Seven. And then you have the John Stoltzfus view of things, which is, it is so nice that people are taking some profits and going into the others, and then they're going to realize everyone just gets lifted up and it's a wonderful evolutionary cycle of innovation and growth, and all of a sudden we can go into everything, and that's how you can get higher. That's sort of the tension right now.
In the driving seat is this right here. Switch on the board and get to the bond market. And let's just sit on the front end. Had a double-digit move yesterday, close to 10 basis points. 450-166 is where the 2-year is right now. We've said repeatedly on this programme, not all rate cuts are created equally. Keep talking about it. Some are bullish, some are bearish. If you're responding to a collapse in the labour market and you're cutting rates, that ain't good. If you're responding to inflation and that backdrop improving and the labour market's holding up, that's a really decent picture. Not just for the economy, but for financial markets. That's what we got in yesterday's session.
The fact that initial jobless claims came in lower than people had previously expected, it basically gave a nod to this Goldilocks that everyone's been hoping for. Key point within the CPI, which also gave people a real sense of relief. Michael Reed of RBC pointed this out. They finally started to see some decline in owner's equivalent rent. That has been the key aspect kind of keeping people back when you start to see that disinflate and things get cheaper. The point is here, right now, it seems like the Fed is threading that needle. And it seems like they're threading that needle just perfectly. And that's the reason why a number of Fed officials are saying, OK, let's go before we don't thread this needle anymore. We don't know yet. The jury is still out. And that is why I think that this earnings season is going to be so important.
JP Morgan, about 10 minutes or so away. We'll break that down for you in just a moment. Talking of threading the needle, no needle threading whatsoever over in Japan. For the Ministry of Finance, this is just about hammers. And when dollar yen's down, just beat it up. Just beat it up even more. We've broken 160, 159.22. Yesterday, we had a little look at 158. At the close, 158.84. We had seen in yesterday's session something close to 162. So you get that dollar weakness. And according to reports, Lisa, the ministry just sort of piling on and intervening.
Yeah, with $22 billion of estimated intervention in terms of trying to encourage this move. That was perfectly described. That was my image last night, was they saw CPI,
Get it.
They saw the move, and then they're like, let's go. This is our chance to put good money after good, or, good money after bad, but actually make it count. Question here is, are they just basically trying to propel a move that's already in the market, basically take advantage of market opportunities, or is this something that's durable at a time where there still are some structural differences between the two economies?
Some big moves in yesterday's session across the equity market, the bond market, and foreign exchange as well. Under surveillance this morning, at least 3 new Democratic lawmakers calling on President Biden to step aside after his news conference last night. Biden making 2 major gaffes in about 2 hours. The president now preparing for another high-stakes interview with NBC's Lester Holt on Monday. I guess we've got to ask the question, Lisa, at what point are interviews no longer high-stake interviews? And if you're looking ahead to next week, my question would actually be not for the president, not for the Biden campaign, it would be for the RNC. Can the Republican convention actually do a good job of keeping out of the news cycle and keeping the pressure on the sitting president?
Well, it's not something that typically Donald Trump has been particularly good at, considering the fact that he enjoys the spotlight and is quite good at it in terms of getting it. Here's the question that I have. At what point are people coming out against Joe Biden, regardless of what he does or what he doesn't do, in terms of messing up or having a real fatal blow in terms of a sort of irreversible gaffe? At a certain point, it feels like people are trying to gain momentum earlier so the damage is staved off and they allow another candidate to get some momentum. That is what I'm am watching, how much people are coalescing, not because they're concerned about another gaffe or something else, or even any kind of disappointment with his performance, which a lot of people think has been pretty good. The issue is, let's get ahead of this, because right now we are losing, and you got to get on this now.
Another big weekend and big week still ahead for us for the President of the United States. Big day yesterday for Tesla. I know sort of overshadowed by some of the news elsewhere, but the company pushing back the debut of its new robo-taxi, according to people familiar with the matter, telling Bloomberg the event won't happen until October, after originally being scheduled for August 8th. Teams are expected to work on additional prototypes. We were down yesterday, we're down again this morning by 2%. Ed Ludlow and the team breaking down the story. We're going to catch up with Ed in about 2 hours' time. This has been the carrot over the stock since April. This August date where we'd get this update on robo-taxis and we'd stop talking about the negative growth that this growth stock's been experiencing for the last few quarters.
So there are two questions. Is he just trying to get it perfectly so that when he unveils it, it's going to be something that's really viable? Or does this highlight some of the difficulties in creating this type of product? We saw the flip side, Uber and Lyft shares gained quite a bit on the heels of this because that competition wasn't necessarily going to come to the fore quite as quickly as some people had previously thought. To me, it seems like the can's getting kicked again and again. And how long is there going to be forgiveness in the market? We saw a sniff of that yesterday. Really, it's going to be interesting to see whether that continues.
Down this morning by a little more than 2%. Let's get to the earnings. Lisa mentioned it. Earnings season kicking off on Wall Street with the big bank set to report throughout this morning. JP Morgan and Wells Fargo expected by 7 a.m. Citi expected to report at 8 o'clock Eastern Time. Goldman, Morgan Stanley, Bank of America all coming next week. Gerard Cassidy of RBC joins us now for more. Gerard, I love doing this with you. Every single time we kick off earnings season for the big banks, walk us through what to look out for in the next hour or so.
Jonathan, I think what we're going to see is a couple of real big trends. First and foremost, net interest income. As you know, the net interest income comparisons for all the banks on a year-over-year basis has been negative, with the exception of JP Morgan. I think that's going to be one of the biggest trends that most investors will focus on. They're looking for the inflection point when net interest income growth on a year-over-year basis turns positive. We expect it to happen in the second and third quarter of this year. Second, credit quality. As you know, we've talked about in the past, the office markets in the United States, in the big cities, in Class B and C buildings, is very weak. There are many losses that are being taken in that area. So we're going to look for insights into that market. Third, for the big banks that are reporting over the next 48 hours or 72 hours, what we're expecting is what's going on in capital markets. The guidance they gave in June, investment banking results, as well as what we see in deal logic numbers, are going to be very strong. Trading results are going to be more muted, but we could see maybe a surprise to the upside there due to the volatility that was created in the second half of June due to what was going on over in France in their political environment.
Jared, to build on that, we have to talk about the last 24 hours. This is a market environment, at least recently, in the last day or so, where smaller companies are being rewarded and bigger companies that have done well so far this year have pulled back. Given the environment that you described for banking, do you think this is an environment where the big just keep getting bigger? Or do you think this is an environment, at least developing into one, where the smaller names can start performing?
John, I think you put your thumb on it. The smaller names can start performing if, as Lisa was just talking about, the Fed threads the needle and we see a Fed funds rate cut in September and December. The smaller names rely more on net interest income as their revenue driver rather than fees, which, of course, the biggest banks have a much bigger percentage of revenue coming from fees. So therefore, if you do believe the Fed's going to cut maybe once or twice this year, maybe 3 times next year, the smaller regionals and regional banks should now take leadership amongst the bank group because of that driver for revenue.
There is this issue, though, about benchmark rates coming down and what that does to some of these banks. Yesterday, we saw kind of a motley performance. Smaller banks did outperform, though, as you mentioned. At what point does that become difficult for loan growth and for making profits on loans, given the fact that a lot of these companies still are dealing with trying to retain deposits?
Lisa, what's really interesting is that if the Fed starts to cut rates, we're going to see what we call the third act of the interest rate cycle, which is your funding costs, your deposit rates start to come down as the Fed cuts rates. But you might remember Many of the banks put on their books bonds back in 2020 and 2021, as well as loans with coupons that were anywhere from 1% to 3%. As those pay off, those cash proceeds are reinvested now in higher yielding earning assets. So you're going to see spreads and margins improve even with minimal or no loan growth. So loan growth would be the icing on the cake for these companies. But even if you get modest loan growth over the next 18 months, the margin expansion just from the dynamic of the earning assets paying off, being reinvested into higher yielding assets and your funding costs coming down means net interest income growth is going to be positive.
We're about to get reports from J.P. Morgan. Then, of course, we're going to hear from Bank of America, and then we're going to be hearing from Wells Fargo, and then from Citigroup. Which of those companies do you think is going to be most interesting?
I think what's going to be interesting is Bank of America, because when you look at J.P. Morgan Chase, obviously they have delivered very strong numbers. Everybody expects that trend to continue. When you look at Bank of America, they have been the bigger net interest income story. We don't think about net interest income as much for the large banks as we just talked about, but this company has had a more focus on net interest income. And you might recall back in 2023, when we had the problems with the banks in the spring of 23, there was a big focus on the unrealized losses in their held to maturity portfolio. And if this 10-year government bond yield continues to fall, those concerns of the lower yields in that portfolio become less of an issue as we go forward. So that's going to be, I think, of the big three, that could be the most interesting one today when they announce their numbers.
The stock has had quite a run so far this year. Year to date, up by a little more than 24% on Bank of America. Gerard, Cassidy, stay close, sir. We're going to break down those numbers from JP Morgan with you in just a couple of minutes' time. Before we get there, an update on stories elsewhere this morning. With your Bloomberg Brief, here's Neuberger. Hey, Danny.
Hey, John. The Bank of Japan is believed to have stepped into the currency market for a third time this year on Thursday. Broker forecasts estimate that the BOJ intervened to the tune of about 3.5 trillion yen. That's about $22 billion. The figures indicate that Japan's authorities tried to take advantage of a buildup of yen shorts and a cooler U.S. inflation print. The yen strengthened sharply from around 161 versus the dollar to 157, but it is back above 159 this morning. The world's biggest hedge funds are off to one of their best starts of the year thanks to a roaring tech-led bull market and successful quant strategies. According to people familiar, tech-focused equity funds Lake Street and Whale Rock led the pack in the first half, gaining 55% and 32% respectively. As a whole, multi-managers gained 6%. That is their second best start to the year over the past 15 years, data from Pivotal Path show. One sore spot, though, lagging macro funds. Brevin Howard and Eisler both posting losses for the 6 months. Food delivery in New York City has become a luxury. A city agency report found that New Yorkers have paid nearly 60% more in delivery fees in the state since minimum wage laws went into effect last year. Customers as a whole ordering from apps like Uber Eats, DoorDash, and Grubhub paid an average of $20 million a week in delivery fees in the first quarter of this year. That's a 58% increase year over year. Meanwhile, delivery couriers saw their overall earnings grow even as tips fell sharply. The agency's report suggests that delivery companies have passed on higher costs to customers. And that's your Bloomberg Brief. John.
Danny, thank you. It's certainly getting more expensive. You noticed that?
Well, you've got the order fee, delivery fee, tip, and then it's all of a sudden double the price. At that point, you start to whip out your cooking books and just tell the kids, just deal with it. I know it's not as good.
Deal with it. Mum's cooking again, which I'm sure is a good thing. I'm sure it's a good thing.
Don't be so sure.
Up next on the program, the big banks kicking off earnings season.
Even under this administration, we're seeing some relief in some of the regulatory constructs. So this whole Basel III endgame rule that would be really, really tough on capital for the banks, Chair Powell said he'll repropose that. And there's nothing more effective for banks than time.
Bank earnings season begins in a couple of minutes' time. Live from New York, welcome to the program. Equity futures firm are here by 0.1%. Under surveillance, big banks kicking off earnings season.
Even under this administration, we're seeing some relief in some of the regulatory constructs. So this whole Basel III endgame rule that would be really, really tough on capital for the banks, Chair Powell said he'll repropose that. And there's nothing more effective for banks than time. If we do have a Trump presidency, that reaction is going to be, gosh, we need to buy the smaller banks because there's going to be potentially, a logjam breaking in terms of consolidation.
It's the latest this morning. We're waiting for numbers from JP Morgan, numbers from Wells Fargo just dropping, Citi reporting at the top of the 8 o'clock hour, Goldman, Morgan Stanley, Bank of America, all reporting next week. To break it all down for you, Bloomberg's Sonali Basak joins us around the table. Sonali, good morning.
Good morning, John. And to your point, we are bringing in numbers from Wells Fargo. They're just crossing the wire. Net interest income is coming in short of expectations. This is the big fear on Wall Street. What happens to net interest income through the remainder of the year? Net interest income of $11.9 billion is under the estimate of $12.1 billion. And so the questions as we absorb these numbers is not only what happens to net interest income. Remember, this is a lot of the reason why you saw a lot of the big banks fall yesterday on the heels of lower interest rates potentially here. You also see questions moving forward about credit losses ahead. I would also point out, if we can, we also have JP Morgan numbers also crossing the wire as well. Some interesting numbers here because you don't see the same kind of muted numbers in JP Morgan as you do in Wells Fargo. I would point off right off the bat here that JP Morgan's return on equity is coming in much higher than expected here. We will absorb the numbers as they come through, but that is a very interesting number to focus in on as JP Morgan's numbers cross the wire, because there was a lot of worry here, not only about any potential pressures on net interest income, but also what you would have had in terms of costs rising over at JP Morgan. That bottom line at JP Morgan was actually the question at the end of the day.
All right, so just taking a look right now, we've got a Wells Fargo missing their net interest income. You have JP Morgan beating it. You also have JP Morgan coming in pretty much in line going forward with revenues, et cetera. I am wondering about credit loan losses. We did see a big gap up in JP Morgan in terms of what they expect credit losses to be. How much does that indicate some sort of forward view in terms of their caution going forward?
You know, you think about 4 days ago what we saw from the New York Fed, expectations from consumers and that worry about availability of credit, and then how much the banks pull back on the heels of those losses starting to rise. Ultimately, that's going to be the biggest question, Lisa. How willing is a JP Morgan, is a Bank of America, is a Citigroup willing to lend in the face of these higher losses?
Decent numbers on the investment banking business side of things. Revenue coming in at $2.46 billion over at JP Morgan. The estimate was 2.13. The commentary from Jamie Dimon. Lisa, how many times have we heard this over the last few quarters? We continue to be vigilant about potential tail risks.
I mean, that's kind of his job, is essentially to be vigilant and handle tail risks. He's talked about that the way that you're successful through cycles is not to get lost in the euphoria on the way up and not to get lost in the sob stories and the trauma on the way down. What you do see is a company that's benefiting pretty broadly from their heft. We're getting the equity sales and trading, they beat. Fixed income sales and trading on the margin, they actually missed a little bit, but pretty much in line. Net interest income coming in strong. To me, the question is how much they keep saying this simply to just offset incredible profits, even when other banks don't show that same kind of strength.
Sonali, just going through business line to business line, what jumps out for you here?
Definitely those core Wall Street businesses. There was a big debate going into this earnings season about just how much Main Street versus Wall Street would start to show up in these numbers. And Wall Street is showing you that they are very much alive. And these trading numbers, equities, for example, winning here, fixed income winning at JP Morgan, is an interesting setup for the rest of earnings season. That volatility in the markets is where these guys start to win. And, I will mention under the surface, one of the big debates here is, will the Federal Reserve and other regulators put more capital rules or, frankly, other types of guardrails on these trading businesses? They are certainly, for the time being, minting money.
Wells Fargo right now down in the pre-market by a little more than 5%. A little bit softer on JP Morgan. Early days, we'll see what happens here. And if this move sticks, we're down about 1.5%. Gerard Cassidy of RBC still with us. Gerard, you've had a few minutes to go over these numbers. What jumps out for you, sir?
I think what's impressive, as you guys have been talking about, is the investment banking and trading results. I think when you take a look at even Wells Fargo, as the net interest income did come in a little bit below expectations, indications their fee revenues were stronger, most likely led by their capital markets business. As you know, Wells has been expanding that business under the leadership of Charlie Scharf. So when we look at the numbers today so far, the investment banking and capital markets numbers are good. When it comes to credit, we know credit is normalizing, but these companies can absorb these higher credit costs because of the diversified revenue numbers.
What do you make, Gerard, of the idea that Wells Fargo missed on net interest income and JP Morgan beat? Is this a function of the fact that deposits are just stickier at JP Morgan and they can afford to not pay that much more to their depositors, which is different than other banks, anyone other than JP Morgan, frankly?
Yeah, it's interesting. The two big banks that have super sticky deposits, Bank of America and JP Morgan. But I would say Wells does too. One thing we have to remember, Lisa, with Wells, they have that cease and desist order with the asset cap. So they're unable to grow their balance sheet. So when you have pressure on your net interest margin, you're not able to grow through that, which JP Morgan, Bank of America, Citi, all the other banks can. So that, I think, is what's showing up here today for Wells, is the asset cap is holding them back because they cannot expand that balance sheet. And therefore, there was pressure on the net interest margin, which brought the net interest income number slightly below expectations.
Gerard, this actually speaks to that. Wells Fargo saying that they saw growth in their deposit balances in all of their businesses. Going back to the capital markets aspect, we did see a real boom there when it comes to most of JP Morgan's businesses, a slight miss on the fixed income side of things. How much is this durable at a time where people are saying that maybe people are trying to get deals done ahead of the election, that the boom is happening now, but then could dry up later in the year?
It's a really good question because there is much uncertainty due to the election. As you know, we're now moving into the slow summer months. Capital markets businesses, this is their weakest quarter, the third quarter. Then we spring right into the full speed election in the fourth quarter. So that could certainly add to the volatility. Volatility, as you know, Lisa, is very good for trading results. That's what the markets business wants. On the other hand, it's not as positive for the investment banking business. However, in all of these companies, JP Morgan, Citi in particular, the markets business, the trading businesses are much larger than the investment banking businesses. So increased volatility would be kind of interesting, though, to your point, maybe you see a slowdown in the investment banking business, particularly amongst IPOs, but the trading business can more than offset that slowdown if the volatility turns out to be, beneficial to trading.
We're jumping between banks at the moment, talking about JP Morgan and Wells Fargo. A little bit later this morning, we get numbers from Citi. I want to sit on JP Morgan, Gerard. I just want to get to these comments from Jamie Dimon. They're comments we've heard before, but I want to talk about the value of this particular perspective that's helped JP Morgan over the last couple of years. Dimon, the CEO, saying this: there's been some progress bringing down inflation, but there are still multiple inflationary forces. Inflation and rates may stay higher than the market expects. That seems to be the bias, the view, Gerard, of Jamie Dimon for quite a while now. How has that helped JP Morgan navigate this rate story of the last couple of years versus, say, other large banks on Wall Street?
John, it's a good point because JP Morgan has navigated the rate environment better than some of their peers by keeping the duration of their assets shorter than some of their peers. The good contrast here is between Bank of America and JP Morgan. Now, if rates continue to fall and the Fed starts to cut rates and the long end of the curve comes down, that obviously will weigh on JP Morgan more so than its peers, which they have pointed out in their guidance in the recent past, that net interest income in a falling rate environment would be adversely impacted more so than their peers. So they've done a very good job. I mean, they are very conservative. Jamie Dimon, their chairman and CEO, has always taken a look that, the glass is kind of half empty to be protective of his business. And that's worked very well for him, obviously, since he's done a great job running this company for the last 20 years.
Gerard Cassidy of RBC. Gerard, thank you, sir, for joining us today alongside Sonali Basak of Bloomberg. Lisa, just going through these numbers, a final word for you. Big headline, a big takeaway.
Well, Jamie Dimon also had some other commentary where he said inflation rates may stay higher than the market expects, as you were talking about, but there are still multiple inflationary forces. And I'm curious about what that's a nod to going forward. Some of our conversations have suggested about policy shifts, but also how that's shifting their balance of businesses, what they're sort of doing to get ahead of that to navigate the waters. But otherwise, to me, it's really a win for Wall Street's trading arms.
Yeah.
And it's a real win for JP Morgan in terms of net interest income.
The bigger you are, the better you've been doing over the last year, that's for sure. JP Morgan's down by a little less than 1 full percentage point. Shanali's going to be back a little bit later to break down numbers from Citi. Yardeni of Yardeni Research joins us in the next hour alongside Democratic donor Charles Mars of Signum Global Advisors, Lara Rhame of FS Investments, and the Secretary General of NATO, Jens Stoltenberg, sitting down with Bloomberg's Anne-Marie.
I don't see any reason why we should be headed for recession here, but we are seeing that slowdown growth.
We are expecting growth to continue to slow. We do think that we're going through a soft patch here, but we think it will be a moderate soft patch.
Things are moving lower in the economy, and historically the Fed has been able to cut rates before the recession actually occurs.
We don't necessarily think there's a recession on the horizon. We think that having a soft landing is quite possible at this point.
The economy looks as if it's slowing. Inflation looks as if it's coming down. To me, this is a winning hand.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
The second hour of Bloomberg Surveillance begins right now. Shanali Basak alongside us in the last couple of moments, breaking down the bank earnings. As she headed towards the exit of the studio, she just turned to us and said, Wall Street wins. This is what it looks like this morning. If you've got a big investment bank and you're winning on that side of things, you're doing okay. JP Morgan just a little bit softer in the pre-market. If you don't have that and the focus is elsewhere, this is what it looks like. Lisa, Wells Fargo down 5.
Well, this one basically is the consequence of Wells Fargo missing on net interest income, JP Morgan beating on net interest income, and then beating on everything else, too. Basically coming in and blowing out of the water some of the trading revenue, particularly when it comes to equities trading. Also notable that they had the best quarter for Mercury advisory revenue going back to the third quarter of 2022 at a time where there still is a lot of uncertainty about what could get approved. This is the biggest bank winning yet again, and that is really the story that stands out.
The big get bigger, and we'll always be talking about the thoughts of Jamie Dimon over at JP Morgan for as long as he's over there. So we have to talk about his thoughts on rates, on inflation. Inflation and rates may stay higher than the market expects. Just contrast that guidance coming out of JP Morgan and the leadership there to what we heard from Pepsi yesterday, what we heard from other companies, including Delta as well.
There is a tension here, which is at what point are we looking at inflationary pressures that might be subsiding for now, but that are going to revert back to the forefront later on. Jamie Dimon saying there are still multiple inflationary forces coming down the pike. That is something people have been talking about with respect to policies as well as just sort of global supply chain issues. On a broader level, there is this feeling that there is a weakening, and that's why you did see credit loan loss reserve actually build more than people previously expected at JP Morgan. It's a confusing picture. And this is a cautious bank that is preparing for that because guess what? They can. They have enough cash.
Just getting some confirmation of the guidance as well. They still see full year net interest income of about $91 billion. The estimate just a little north of that. The estimate was $91.33 billion. So I think we can say largely in line, just a little bit softer in the pre-market. So we've had JP Morgan, we've had Wells Fargo. Later on today, we're going to get numbers from Citi as well in the next 60 minutes or so. After that, we'll get PPI, so inflation data for you. Then after that, the University of Michigan consumer sentiment numbers going into the weekend. As we look at the totality of the data, as the Fed might say, the data this week looking a whole lot better after what we saw yesterday.
It was a Goldilocks kind of feel, right? You basically had CPI coming down at one of the fastest paces going back several years. You had at the lowest level going back several years on an annualized basis. You saw actually the housing component of this print come down in a way that gave people confidence that maybe it has legs. And you had jobless claims not come in higher than expected, in fact, come in lower than expected. So it looks like a stable economy that is seeing disinflation, the immaculate disinflation. Key question to me is how much do earnings change that story? I'm not talking about JP Morgan, but I'm talking about Delta. I'm talking about Lufthansa, which came out this morning and also downgraded their forecast for revenues. I know they're not an American company, but it gives a sense of just global travel. You talk about Pepsi, Conagra, At what point do you start to see the weakness coming out in other ways that might not be reflected in, say, investment banking revenues?
In a few words from Neil Dutta of Rhame, get on with it.
Well, yes, he's been saying that for a while.
Get on with it. That's the message to Chairman Powell and the Federal Reserve as they get together later this month to consider reducing interest rates. Most people assume they will execute that call later on this year, perhaps even in September. The scores look like this morning, and good morning and welcome to the programme to you all. Equity futures on the S&P 500 just about positive. The bigger move, though, like yesterday, was in small caps once again this morning. It's on the Russell. It's in small caps. In the bond market, yields much lower across the curve through yesterday's session. This morning, a little bit higher on a 10-year maturity, up by about a single basis point. 421.97 is where 10s are right now. The lineup for the hour ahead of us looks like this. Ed Yardeni of Yardeni Research will be joining us as stocks snap their longest winning streak since November. Charles Myers of Signum Global Advisors as President Biden vows to stay in the race. And we'll speak to Lara Rhame of FS Investments amid growing bets on a September rate cut. We begin with our top story, the S&P 500 7-day winning streak coming to an end as big tech tumbles the most since 2022. Ed Yardeni of Yardeni Research raising his S&P 500 year-end target to 5,800 from 54, writing this: "We've been among the most bullish investment strategists since November 22, but not bullish enough. The bull market might continue to achieve our targets ahead of schedule." Ed joins us now for more. Ed, we keep going back to this, the rotation of yesterday. How durable do you think that so-called rotation is?
I think it might have been very significant simply because we see that it was based on expectations that the Fed is in fact going to start lowering interest rates sooner rather than later, meaning September, rather than sometime next year. And I think everybody agrees, especially after listening to Fed Chair Powell, that this is going to happen. If that's the case, then the rotation makes sense and may very well continue.
So, Ed, is it the everything trade or the everything else trade?
Well, I think, look, from my perspective, the Fed doesn't really need to lower interest rates. Economy's doing fine. Maybe it's a soft patch, but it's certainly not a recession. And inflation's coming down. So why mess with success? I think the risk they're taking by actually lowering rates, let's say in September, is that they'll just perpetuate a melt-up situation in the stock market. You know, deja vu all over again, the 1990s. But look, just because I have an opinion on what the Fed should do is irrelevant. What matters is what they're going to do, and they seem very intent on cutting rates.
It actually matters what you think they should do, just in terms of what the market seems to believe as well. And I'm wondering how much of a small cap trade right now is hinged on the idea that the U.S. economy has more risk of actually heating back up than cooling back down to some sort of recessionary state.
Well, look, if in fact the consensus view now that the Fed's going to lower interest rates happens and the stock market continues to move ahead, you know, I've been bullish, but not bullish enough. But so if it continues to move ahead here, that could certainly have a very positive wealth effect on the economy. The financial conditions are not tight here. You know, the Fed keeps talking about the need to lower interest rates because otherwise they're too restrictive. I mean, we're talking about the stock market basically at a record high here. Not, you know, after last. I mean, yesterday was kind of the first weekday for the S&P 500, but the broad market actually did pretty good as it broadened out to the small caps and the mid caps, and I think that continues.
Let's turn this on its head. If you think that there is so much momentum in the U.S. economy that if the Fed cuts in September, the risks will sort of shift to possibly a reignition of inflation, at what point does it make you more bearish on bonds? We see in the short-term bond space, not a lot of hiccups, but one auction after another came out pretty well until yesterday. And we saw that 30-year auction not do so hot. How much do you get, you know, pretty bearish on the prospects for U.S. government debt if the Fed cuts as soon as to September?
Well, we've all been very excited about yesterday's CPI, but that was in the morning, and in the afternoon, the federal deficit came out, and that certainly reminded us that there's lots of supply of government securities. As a matter of fact, the net interest income now is bigger than defense spending. So you put it all together, and you know, we still have a supply demand issue in the bond market that I think keeps the bond yield above 4%, even if we continue to see moderation in inflation, which we expect, and even if we see a Fed rate cut in September. But yeah, I mean, the worst thing that could happen to the Fed is that they cut in September and then regret it shortly thereafter. We've seen a couple of other central banks kind of go into this regret mode after they cut rates, the ECB being a good example of that.
Just forgive me, I'm in shock. I can't believe how quickly Lisa managed to make this a bearish conversation. How did you manage that?
Okay, hold on. I'm just trying to figure out what the implications are if you see that there is enough momentum in the economy to not warrant a rate cut. That's all. And we talked about the deficit.
Ed, political considerations, how dominant are they for you going into November?
Well, I mean, you have to take Jay Powell at his word, and he's insistent that politics has no impact whatsoever on what the Fed does. Maybe that's his view, but the views of each of the Fed officials may very well have some political context in which they make their decisions. In a political world, in a partisan world like this, the Fed would probably, from a political standpoint, be best off doing nothing. But Powell's made it clear that they're going to go with the economic data. They're not going to be influenced by the political cycle.
How much does it influence your views, Ed? Just as it pertains to capital allocation, equity decisions, where you want to park that money in stocks?
Well, over the years, I think we've all learned, I've certainly learned, that you never want to let political considerations bias your investment decision-making. Whether it was Obama or Trump or Biden, the stock market just kept going up, even though the policies were radically different among those three, for example. And we can go back further in history and find that Washington, more often than not, is sort of a sideshow. What really matters is the strength of the economy, which is driven by all of us working stiffs that are working. And making the economy work for everybody. So I am concerned, though. I mean, I guess we always look at the next presidential election as the most important one in American history, and I think everybody has that view about the upcoming one. And certainly we have the most divisive partisan candidates we've ever had for that job, and that creates uncertainty for the stock market. I mean, we'd like the political process to be smooth without a whole bunch of drama, but just because we like it doesn't mean we get it.
Talking about working stiffs, let's go to regulation. I am curious, Ed, before we finish up, there is this feeling that regardless of who wins, there has been a seismic shift, in part by the Supreme Court and the Chevron doctrine, and just how much some of these companies and more highly regulated industries will really be regulated going forward. Is that something, as we get all of these financial earnings, is that something that could shift you into more regulated sectors with the anticipation that they will be released from those shackles?
Yeah, I think that's a great point, and I think it's a huge development that is getting some press, but really maybe deserves a lot more press, and that is the Supreme Court decision that you're alluding to, in which the regulatory bodies have just been shackled. They're not going to be as powerful, as free, as independent to decide how the rest of us need to be regulated. It's going to be much tougher for them to have that kind of power, and we, the citizens, can go to court and challenge their legitimacy in some of the rulings that they make. So we're entering a period here of Supreme Court imposed deregulation, if you will, and that could be very significant, as you said, for highly regulated companies, particularly in the energy field.
Ed, thank you, sir. We've covered a lot of ground. Sure. Appreciate it. Ed Yardeni of Yardeni Research on the equity market. New price target on the S&P, 5,800, up from 54. If you're just joining us and you've got one question, I guess, are we repeating the price action of yesterday? The answer is yes, to some extent. We're up by 0.8% on the Russell. We're down on the Nasdaq 100 by 0.1% and the S&P 500 is going nowhere. Let's get you an update on stories elsewhere this morning with your Bloomberg Brief. Here's Danny Berger. Hey, Danny.
Hey, John. Just a quick recap of what we've heard from the big banks reporting so far this morning. JP Morgan, a record profit that included a 50% jump in investment banking fees and a 21% jump in equity trading revenue to near $3 billion. Different story over at Wells Fargo. Net interest income missed analyst estimates, falling to its lowest level in about 2 years, but it did reaffirm its view for the full year. We'll get the results from Citi in less than an hour's time. AT&T has suffered a massive hack of customer data, one of the biggest breaches of private communications data in recent memory. The hack included records of calls and texts for nearly all of its mobile phone users for a 6-month period in 2022. It is separate from an incident reported earlier this year. The company said in a regulatory filing that the breach also included records for customers of wireless server providers that used AT&T's network between May 1st and October 31st of 2022. And some more bad news for the Biden campaign. Reuters reporting that the United Auto Workers president Shawn Fain met with the union's executive board late Thursday to discuss his concerns about President Biden. The union is considering next steps as worries continue to spread among Biden supporters following his most recent gaffes, including misnaming Vice President Harris and Ukraine President Zelensky in post-NATO remarks. The UAW and the Biden campaign both declined to comment. And that's your Bloomberg Brief. John.
Danny, thank you. Appreciate the roundup of all the news this morning. We'll catch up with Danny again in about 30 minutes' time. Up next on the program, the president not backing down.
There's a long way to go in this campaign. And so I'm just going to keep moving. I'm not in this for my legacy. I'm in this to complete the job I started.
That conversation up next, live from New York this morning. Good morning. Equities on the S&P 500 just about unchanged. Likewise in the bond market, no drama there. Your 10-year yield 4.2158. Again, small caps outperforming, becoming a theme in the last 24 hours. Under surveillance this morning, the president not backing down.
The consideration is that I think I'm the most qualified person to run for president. I beat him once, and I will beat him again. There's a long way to go in this campaign. And so I'm just going to keep moving, and because, look, I got more work to do. I'm not in this for my legacy. I'm in this to complete the job I started.
Here's the latest. President Biden vowing to stay in the race despite deepening concerns about his fitness to serve for a second term. At least 3 more Democratic lawmakers calling for Biden to drop out of the race following last night's press conference, bringing the total up to 17. Anne-Marie's in Washington for us this week and has more. Morning, AMH.
Good morning, John. That press conference last night absolutely overshadowed by Biden's age. Every single question, the majority of them linked back to his age. And of course, they were also overshadowed that the gaffe the president had going into that press conference. The fact that he called President Zelensky President Putin, and then his first question at the press conference, he called his Vice President Trump. That is why it wasn't enough to assuage these concerns. And that is why you had more lawmakers coming out last night. Most notably, the ranking member on the Intel Committee, Congressman Jim Himes, coming out last night and talking about the fact that he thinks this is really sick, what is going on. The fact of the matter is that it's this aspect, this sick moments of these aspects. They're watching every speech, every rally, every debate to see if the president messes up. And that is why there's concern. Can the Democratic Party even have policy discussions if they're going to continue to focus on the president's mishaps and his age?
Anne-Marie, thank you. And this was the problem yesterday, Lisa. It didn't matter how well that news conference was going to go. That wasn't going to change anyone's mind anytime soon.
And you got the sense that some Congress members were waiting until the NATO confab was done before coming out and expressing their displeasure and their wish for him to step down. It almost didn't matter how the press conference went.
Press send almost as soon as it ended. Did you notice
exactly,
that?
But
just
that's
like bang.
Yes. It was a predetermined kind of decision, and that is sort of what stands out to me.
Certainly felt that way. Charles Mars joins us now of Signum Global Advisors. Charlie, great to catch up with you, sir. A line that you've mentioned before, and I'm going to read it again for our audience. I think he stays in longer than most people predict. Charles, what are the pillars that underpin that particular view?
Yeah, absolutely. Thanks for having me back, by the way. Just quickly, if I can, on the press conference, it was probably the most watched cognitive test in the entire, history of the world. There was something in there for everyone. I don't totally agree with your reporter's assessment a moment ago. There were two main gaffes. There are gaffes all the time. They will go viral. They have gone viral. But there was also some pretty substantive answers on foreign policy and domestic policy. So there was a bit of something in there for almost everyone. If you wanted to not like him or you're worried about his age, you got it a bit. If you wanted to be reassured, you were also reassured. Here's what I'm watching to answer your question on what he does. There are really three things. First, will the Democratic congressional leadership stick with him? Nancy Pelosi, Hakeem Jeffries, Chuck Schumer, and Jim Clyburn. Schumer and Pelosi 3 days ago, in the last 3 days, have kind of opened the door a little bit for him to possibly think about dropping out, but they have not abandoned him. We need to watch that most closely. Yes, there's 17 members of Congress that have now called for him to step aside, but we need to watch the leadership. Secondly, very quickly, is polling in the swing states. In the 6 swing states, hasn't moved much yet, but it's early. We want to watch that. Third is fundraising. Is fundraising really drying up, or is it still a handful of donors that have come out publicly against the president? We need more data. We'll probably get that in the next 2 weeks.
Time is against him right now, and time is against, frankly, the Democratic Party, especially at a time where yesterday we were all talking about the press conference. We weren't talking about the inflation data and the sort of Goldilocks reports that we got at 8:30 a.m. Eastern. At what point will there be a sense of urgency? Not let's wait and see. Let's just gather some sort of consensus. Will there be some sort of come to Jesus moment where people kind of say, all right, let's make some actions here?
Yeah, look, I think you're right, because, the issues around his age, his cognitive, decline, his fitness is dominating the news cycle, as opposed to, let's talk about the issues in this election and let's turn it back to Biden versus Trump. But the president's about to get a reprieve because the Republican National Convention starts Monday. President Trump is going to pick his running mate at some point between Monday and Wednesday. Again, that'll be the news. So I think we're going to get a little bit of a break here on this question of Biden's fitness. Secondly, I would just point out that while the media and a lot of other folks are most focused on Biden's age and, again, fitness for office, the truth is the average voter in the 6 swing states actually really cares about the issues, the economy, a woman's right to choose, border security, defense of democracy, take your pick. They really do care about issues. I think in 2 weeks, we will not be talking about Biden's age.
There is a concern, though, especially at an event like NATO, where internationally there are some real consequences to how your leader comes across, to how your leader presents himself or herself. And there is a sense of where the vulnerabilities are if there are all sorts of discussions about not being able to respond at certain times. I'm just wondering at what point that gets enough attention by the donor class who say, wait a second, this isn't what the image we want to project.
No, absolutely. Look, there are a lot of, Americans and donors who also worry about Trump's response to any international crisis, even though he's sharper. So, but yes, I'm not discounting the importance of the decision making of the president of the United States, especially in a moment of crisis. But, the truth is, as you mentioned earlier, part of your earlier question, he's not going to drop out anytime soon. There's, first of all, no mechanism to remove him aside from the delegates at the convention. 99% of the delegates are his. They're not going to do it. And so it will take, again, the congressional leadership, Democratic leadership, a big group of donors, but also polling to force him out. And lastly, I would just, add that while there's been a lot of reporting of Pelosi and Obama colluding or meeting and talking about his exit, I hope they're meeting. I hope party leaders are meeting considering all options, right? I mean, that's what you do in politics. You need a plan B, a plan C, and a plan D. Plan B is Kamala Harris. But I'm glad that Pelosi's talking to Obama, et cetera.
Charles, it's great to get your views, as always. As I said last time, we've got to keep doing this and get an update from you. Charles Mars there of Signum Global Advisors. Just to build on some of this, I think what we've seen over the last couple of weeks, and we've seen many things, but here's one. I think what we've witnessed is party officials regret deeply in public that they didn't have a more robust primary in the Democratic Party. And if they had have had one, a key tenet of Biden's campaign would have been, I'm the only guy who can beat the former President Donald Trump. And in some sense, I think a takeaway from me from that news conference yesterday is, yes, there were gaffes. And yes, I think we all agree with Charles. He did have command over some pretty complex subjects throughout the hour of that Q&A. But a key question for me that I'd have now is he opened the door and undermined a key tenet of his campaign, which is I'm the only guy that can beat the other guy.
which places such key emphasis on polling, right? Is that going to be the ultimate cudgel that could potentially get him out of office if you get the polls that really start to push against his ability to win and maybe give the opening to somebody else who could win? There just is this feeling that maybe he would then consider stepping aside. I don't know. I thought it was really interesting when someone asked him, weren't you the bridge candidate between a younger generation?
What happened?
What happened? And that was a bit of a fumbled answer, in my opinion.
The conversation continues. Coming up on the programme, we'll speak to Lara Rhame of FS Investments from New York City this morning. That's up next. This is Bloomberg. Equity futures on the S&P 500 unchanged. The standout, the word of the last 24 hours, starts with R. You know what it is. Rotation. Heard it on repeat for the last day or so. You're going to hear it again this morning with the Russell up by another 0.9%. The moves we saw yesterday, Lisa, coming out of mega cap tech. If you strip out the muscle of big cap tech, market looks good. You include it, market doesn't look good at all.
The fact that equal weight S&P 500 gained nearly 1.2% at a time where the overall index was down a similar amount, where you saw the NASDAQ down almost 2%, gives you a sense of just how big of a divergence there really is. The real question, you've been asking it all morning, it's the right question, how durable is it? And also, how much is this people selling the winners to go into some of the more beaten up, less loved stocks in order to have bigger gains? Is this fear? I mean, is this greed, not fear? And essentially, how long can that go on, given that people have been talking about a weakening economy?
I had one question about one particular dimension, one specific dimension of yesterday's rally. It was the home builders. Home builders ripped too. Home builders did nicely as well in a rising rate environment, and now we've sort of got these bets they'll do well when we cut rates as well. Been asking this a few times. You've asked this question. I think it's a great question. Just to test how people are thinking about the world. Are house prices going up or down when they cut interest rates in America? What happens here?
Nobody knows. And basically, you can make an argument that if you cut rates, prices go up in houses because more supply comes onto the market. But it's not enough to offset the lack of housing, the dearth of housing, and more people can then get mortgages. Other people say the prices will go down because the supply glut will overwhelm the demand, right? Pick your poison, go for it. Home builders have been struggling a little bit more of late, in part because costs have gotten a little bit more punitive and for them to borrow. So could there be some sort of reversal of that just to add to their boom? I guess that's why we've got a market.
Let's get into the rate story, and we can talk about what's at the epicenter of a lot of that conversation. Your two-year yield at the moment, 450.82. Yields dropping right across the curve yesterday, given what we saw in CPI, softer, jobless claims, right kind of downside surprise. Can we repeat that labour market data in the weeks to come? That's what I'd have to ask, because that data point yesterday goes against the grain of the last couple of weeks.
Yeah, especially because we got earnings earlier in the morning that really were not very positive at all. It's a great question, especially at a time where people had been talking about signs of weakening. And then the flip side to that is, if there is that labor market strength, what's to say that this kind of disinflation is durable? You know, Ed Yardeni was talking about that. I thought it was a really important point. It sort of raises this question, if the labor market is so good, why should the Fed cut at all if there still is this risk of some sort of reignition of inflation? I find it fascinating that you are seeing the yield curve steepening out, and it's because of both the short end going down. But today, the fact that the long end is going up gives you a sense of maybe on the margins just hedging that longer-term inflation story.
How many times has Chairman Powell said something along the lines of, we don't have the confidence yet that we're on a sustainable path back towards 2% and we're waiting to get more confidence? Didn't you hear a couple of officials in the last 24 hours that basically said they've got it? I wonder if we get a little bit of dissent at the end of this month, going into the September meeting.
I'm looking at you, Austin Goolsbee. I'm looking at you, Mary Daly, although Mary Daly is a bit more hedged. Austin Goolsbee is saying this is what the path to 2% looks like. He said those words. Mary Daly saying this goes a long way. Key question for me is, do you still feel that there is like a sense of shared commonality among the officials? It'll be interesting. Do they kind of come out pretty aggressively?
Let's see how much pushback we actually get. Bit of pushback on dollar yen, that pushback coming from the Japanese authorities reportedly. The idea being that yesterday we got some real dollar weakness, dollar yen gaps lower, and they piled on reportedly. Look at the range we've had on dollar yen today. The higher the session, I think we looked at 159.45, lower the session 157.76. We've been all over the place in the last day.
Is this their playbook that essentially anytime there's data that would indicate weaker dollar, they pile on and just add billions of dollars to try to exacerbate the strength in the yen on that particular day? Is that essentially what new intervention looks like? The estimates is that they intervened to the tune of about $22 billion in yen.
They would love to introduce some two-way risk. Let's see if they can maintain that. We're back to 159. These are levels they do not want. We all remember the days when we were talking about breaking 150 and that was the big line of the sand, and here we are still close to 160. That's the price action under surveillance this morning. Your top story, President Biden vowing to stay in the race amid deepening concerns about his fitness for a second term. At least 3 more House Democrats joining the growing list of lawmakers calling on him to step aside. It is unusual to say that every single interview, every single news conference is high stakes, but that unusual backdrop for Washington is likely to continue. On Monday, we'll get another interview and everyone will say it's a high-stakes interview for President Biden.
When it comes to the market implication, how much is this basically giving legs and giving ammunition to the whole Trump trade that it really started a couple of weeks ago? Is there sort of a sense of what the Kamala Harris trade would be or some other potential options? I'm just wondering about the kind of volatility that this could introduce when so many guests come around this table and say it's noise, not any kind of signal.
I got a note from a Bloomberg customer just moments ago, a subscriber. I love how Lisa says the donor class. I want to be in the donor class. Money I can set on fire and feel good about. They said you're the best. I agree.
Thanks.
I love that too.
I mean, I'm just thinking, who has, the capacity to do that? I'm just thinking.
Throw money on a burning fire.
Okay, well,
Yeah.
You could call it a burning fire. You could talk about civil duty.
True. Some people might have a different opinion on that, of course. Wide range of perspectives, as always, on this programme. JP Morgan delivering better than expected investment banking revenue. This coming as Wells Fargo misses estimates on net interest income. We'll get Citi numbers in about 25 minutes' time. The CEO of JP Morgan, Jamie Dimon, going on to say this: there has been some progress bringing down inflation, but there are still many inflationary forces in front of us. Wells Fargo getting punished. We're down 6%. JP Morgan doing OK, down 1.5.
Well, net interest income really was the reason why. The fact that Wells Fargo, which is a lending bank, it has been traditionally been a small business kind of place, came in at $11.9 billion versus the estimate of $12.1 billion, was a big blow. JP Morgan's bolstered by everything because they're just the biggest and strongest, and they always seem to win. And they've been bolstered significantly by the fact that, as Sonali Basak said, Wall Street wins. We shall see with Citi, and I actually am really curious with Citi, possibly even more so, given some of the restructuring and how that's going and how that's playing out in some of the numbers.
That stock has done so well, hasn't it? Citi, over the last year or so. Just a programming note for you, 8 o'clock Eastern time. Won't just get Citi numbers, we'll also get the media call for JP Morgan. 8:30, the analyst call will begin. So expect more headlines coming from C-suite executives from that particular bank in the next 60 minutes or so. Let's talk about the data. Investors awaiting US PPI data after a soft CPI print yesterday bolstered bets on a September rate cut. Chicago Fed President Austin Goolsbee saying he's confident inflation is on a path to 2%. Lara Rhame of FS Investments writing this: we believe the Fed will cut in September as the June report confirmed inflation momentum. We expect rate cuts will be surgical, not programmatic. Lara joins us now for more. Lara, where does that distinction come from, surgical versus programmatic?
I think when I look ahead, not just at what's expected from markets this year, but next year, this idea that they're going to be able to just cut once a quarter, sort of on autopilot, I think is a huge mistake by markets, because today, while we have seen, 2 reports in a row that have looked really good, we've also still gotten some inflation whack-a-mole. Not as badly as we did in 2022, early 2023, but we're still getting sectors popping up that are a problem. The latest one, the insurance data, really had caused that super core number to continue to stay really elevated. It's dissipating now, but we cannot, I think, get too complacent on inflation. When I look ahead, I still see, even at the beginning of 2025, rents starting to become a problem again. This is not something that is just going to happen sort of miraculously as everybody had expected at the beginning of or the end of last year.
Sounds like you agree with Jamie Dimon. This is what the JP Morgan boss had to say. We quoted him just moments ago. There are still many inflationary forces in front of us. When you say rents might still be a problem, Lara, what's driving that? What makes that sustainable? Where does that come from?
When you look ahead, you're starting to see, after months and quarters of rents coming in sort of below trend. We are now looking, and you talk about, supply dynamics. It's actually pretty easy to look ahead and see supply dynamics in the multifamily space. We've seen construction starts in that space plunge. We've seen, that is an 18 to 20 month lead time. So when you look ahead at supply that's expected in 2025, 2026, it's as low as it was during the wake of the financial crisis. So I think we're heading, at a time when, let's face it, the supply of single family homes is not really, I think, going to be able to sort of come online very speedily. And again, the dynamics of the millennium cohort, they're just a big cohort and they want homes. So you put it all together, I think you're going to see some of the rent pressure. And again, we don't know what policies are going to be in place in the beginning of next year. Should we get a Trump presidency? Those policies are inflationary. So, you put it all together, I think it's not the time to get complacent. The Fed is going to want to pick and choose depending on the data. We can't assume they're going to be able to just sort of go on some automatic program.
We'll get to the politics in just a second. I do want to pick up on what you just said there, but just sort of putting together this idea of surgical rate cuts and then this concept of a fear of a policy error in terms of cutting too soon that could reignite inflation. How big of a difference would 25 basis points of a rate cut or even 50 basis point of a rate cut make in terms of helping to reignite inflation?
I think you're right, Lisa, that when you look at sort of the risk of cutting a little bit and making sort of a nip and a tuck is not significant, especially because, we all look at sort of things like housing affordability. That's much more of a long-term interest rate story than really a Fed funds rate story. So, I think there's no real harm to a 25 basis point rate cut. It's not going to sort of cause some inflationary brush fire to pick up. That's why the Fed, I think, is going to seize this moment in the wake of these good inflation reports and start down that rate cut path. But it's really looking ahead, and markets getting too cavalier in assuming that they're going to be able to take this opportunity and read that forward into multiple quarters. I think that's where we need to really make the distinction.
So just going back to the politics of the moment, because you went there and everyone's been talking about it ad nauseum. I'm sure some people are immediately just tune out. I am curious about the idea of Trump being more inflationary at a time where some people say some of the proposals that would be inflationary would also dampen growth and would therefore have a one-time inflation effect, but longer term, actually, if anything, disinflationary. What's your take on that?
I think, when I look at both candidates' proposals, one of them is, strongly sort of pro-spending, which, is the momentum that got inflation on the higher end of the comfortable spectrum to begin with. The other one, and I think, when I think about the labor supply dynamics and some of the acute wage pressure that has emerged in that sort of services worker sector, when you think about sort of removing a large amount of labor supply from that, you end up with, I think, a wage dynamic that makes inflation hard to, again, get back to 2%. I actually, think that neither candidate, both candidates want a strong economy at the end of the day. And until we actually get a policy proposal, I am very careful to take campaign rhetoric and impose that on sort of a policy recommendation. But I think when you look ahead to next year, we got really complacent on inflation and everything has to go perfectly to keep it at 2%. Yeah. When you think about next year, I think you're probably still looking at inflation that's sticky and stubborn above that 2% target.
That's the difference between being an economist and a trader, Lara. You have time to sort of formulate the thoughts. Traders are just like, this is what I feel, let's go. It's going to be the inflationary candidate. I'm going to trade accordingly.
I love how people come on the show and they say the market just needs to have patience. And then traders are like,
you don't have the luxury of time.
What?
Lara Rhame of FS Investments. Lara, a patient Lara. Thank you. Let's get you an update on stories elsewhere this morning with your Bloomberg Brief. Here's Danny Berger. Hey, Danny.
Hey, John. Novo Nordisk Ozempic was linked to lower rates of dementia and a range of other mental problems, according to a University of Oxford study. After a year on Ozempic, patients had a 48% lower risk of dementia versus those who took an older medicine. The study is the latest to show potential benefits beyond diabetes and obesity control. Hungarian Prime Minister Viktor Orban traveled to Florida to meet with Donald Trump, the latest stop on his self-styled peace mission to resolve the Ukraine war. Orban posting on X an apparent reference to his belief that a Trump presidency would result in a quicker resolution, saying, quote, he's going to solve it. Orban is the EU leader with the closest ties to Russian President Vladimir Putin. Orban has also worked to stall Western aid to Ukraine. Last week, he blindsided the EU by meeting with Putin in Moscow and Chinese President Xi Jinping in Beijing. Jurors in the bribery trial of U.S. Senator Bob Menendez are set to begin deliberations today after a 2-month trial in New York federal court. Menendez faces 18 criminal counts, including bribery, extortion, conspiracy, and acting as a foreign agent of Egypt. He is accused of taking 13 gold bars, nearly $500,000 in cash, and a Mercedes-Benz from 3 businessmen. Menendez's lawyers blamed his wife for keeping her husband in the dark about her financial problems and the gifts she received. And that's your brief, John.
Danny, thank you. I've got thoughts, but given this is an ongoing case, I should probably not share them.
Oh, yeah.
So let's park the case.
Let's just imagine the case isn't happening.
Case is parked.
Yes.
I'm talking about the case.
Okay, but
blaming your wife for something like this is something, isn't it? You know, sort of like just throwing your wife under the bus.
Well, I mean, it basically is what happens if you know you're going to be
work at home.
locked
Not this
up in
case,
jail.
just
Not in this case. If you might end up in jail, it's sort of like, basically throwing everything you've got because, I don't know.
It's rough, eh? That's tough.
Home life?
Yeah. If you were in that situation, not this case.
Let's assume.
Up next, let's assume it a lot. The US reaffirming Ukraine's military limits.
First thing about Zelensky asking for the ability to strike deep into Russia. We've allowed Zelensky to use American weapons in the near term, in the near or abroad, into Russia.
We'll get you some clarity on those comments in just a moment. From New York, this is Bloomberg. The S&P 500 just about unchanged here in the equity market. Yields going nowhere too. Your 10-year 421.39. Under surveillance this morning, the US reaffirming Ukraine's military limits.
First thing about Zelensky asking for the ability to strike deep into Russia. We've allowed Zelensky to use American weapons in the near term, in the near or abroad, into Russia. If he had the capacity to strike Moscow, strike the Kremlin, would that make sense? It wouldn't. The question is, what's the best use of the weaponry he has?
And this is what's deeply upsetting about the last week or so, particularly the last 24 hours. That was the president wrapping up NATO's 75th anniversary meeting at a time where there are 2 hot wars. We've just had a news conference where a lot of people in that room were more preoccupied, more interested in what time the president of the United States goes to bed. And that's a distraction at a time when we need to be having serious conversations about American policy.
Especially because the implications of what he was talking about is the potential for a broadening out in an existential threat, arguably, for Europe. So there's this real issue of, okay, why are we not talking about how to resolve this in a more concrete way and help people get back to their lives and not watch and witness mass death?
That distraction's not going away because, by definition, the president is only getting older. Anne-Marie in Washington is alongside a special guest in D.C. AMH, good morning.
Good morning, John. The distraction's not going away, but one individual that is hyper-focused on the actual policies that were discussed this week is, of course, the NATO Secretary General Jens Stoltenberg. And this was his final NATO summit. You're going to be retiring in the fall. You've been at the helm for a decade, so you've seen a lot. We're going to get into some of those distractions that were happening at the summit, but I want to get into some of the policies. We just heard President Biden there talking about the limits they've placed on Ukraine about striking deeper into Russia. He basically said they don't want to give him capacity to hit the Kremlin. But Zelensky is asking to attack Russian jets on Russian air bases that strike Ukrainian cities. Do you get the sense that the U.S. doesn't trust Zelensky?
Well, first of all, the U.S. and other allies have loosened the restrictions they have imposed on the use of the weapons they have donated to Ukraine. So Ukraine is now able to also strike against military targets inside Russia. And we need to remember what this is. This is a war of aggression. Russia has attacked Ukraine. That's violation of international law. Ukraine has the right, according to international law, to defend themselves. And that includes also striking legitimate military targets inside the territory of Russia. And some allies have given them that permission. Other allies have some restrictions, but they have been loosened up a bit.
But of course, the most important ally sending the most weaponry is the United States. And they've only said you can go about 40 kilometers. But Zelensky's point is to really start to push back the Russians and be defensive. They need to get on top of it, meaning going maybe 300 kilometers. Do you think, you were part of these discussions, do you think this is something the United States, we've seen them before drag their feet and then make decisions that Zelensky was pushing for. Could you see them coming around to this?
This was an issue that was discussed at the NATO summit. And again, some allies have no restrictions on the use of the weapons they have delivered. Others have restrictions but have loosened them. The U.S. is, of course, important, but half of the military support to Ukraine comes from non-U.S. allies, comes from Europe and Canada. So when it comes to Ukraine, the Europeans have really stepped up, and with the decision we made at the NATO summit to have a long-term pledge and to have a formula for burden sharing, we will ensure that also in the future European allies and Canada will provide half of the military support because they have half of the economic strength of the alliance.
Ukraine didn't get the formal invitation they were hoping for. So they are still at the gates, knocking on the door, and they're not let into NATO just yet. While they do this, though, it unnerves Putin. Do you think they're, in a sense, almost the worst position, this security purgatory, because they're still stuck in the middle, because they're not yet in the alliance, but even asking to be in the alliance really underscores the issue that they're having with their neighbor next door?
At this summit, allies were very clear that Ukraine will become a member. We also stated that this is a irreversible path towards a membership. But actually, as important, or perhaps even more important than the language in the statement we agreed, is that actually we took actions to move Ukraine closer to membership. We established a NATO command with 700 personnel to organize the provision of training and military support to Ukraine. We agreed this long-term pledge, and we stepped up the work to do what we call interoperability, to ensure that Ukrainian forces are fully interoperable with NATO forces. These are concrete actions that actually helps them to prevail, to help Ukraine to prevail as a sovereign, independent nation in Europe. And all of that moves them closer to membership. And then when the time is right and allies agree, they will become members straight away.
As you know, politics overshadowed this summit. Everyone was talking about, if not officially, unofficially, President Biden's age. As the NATO Secretary General, who's worked with both of these U.S. presidents who are the candidates for November, do you see potential change in the future U.S. commitment to the alliance?
I expect that the United States will remain a strong NATO ally also in the future for at least three reasons. One is that this is in the U.S. security interest to have a strong NATO. In NATO, the United States has something Russia and China doesn't have, more than 30 friends and allies. Second, it's very strong bipartisan support in the United States for NATO. In the public, we have seen new opinion polls also confirming that, but also in the U.S. Congress. I met congressmen from both parties, and they all expressed some strong support to NATO. And thirdly, the main criticism from former President Trump and others have actually not been against NATO. It has been against NATO allies not spending enough on NATO, and that has changed. Over just the last years, we have seen a significant increase in the number of allies spending at least 2% of GDP on defense, which is the NATO guideline.
So is your expectation to ignore potentially your expectations that Trump's rhetoric will not match his policies on the ground?
Well, I worked with him when he was Prime President last time, and again, I expect that the United States will remain a strong NATO ally, because this also makes the United States safer and stronger. The United States is big, 25% of the world's GDP, but together with NATO allies, we are 50% of the world's GDP, twice as big, 50% of the world's military might, and this makes the United States stronger. And the main criticism, the fact that European allies didn't spend, that has really changed. 23 allies spending 2%, and those allies who are not yet at 2% have a promise to be there soon. So this has really improved, not least because the criticism from the United States was valid, and Europeans have heard the call and have stepped up.
Jens Stoltenberg, thank you so much for your time. That was, of course, John, Jens Stoltenberg, the outgoing NATO chief.
Anne-Marie, thank you. Thank you very much. And the incoming NATO chief, Mark Rutte, former Dutch Prime Minister, who we know well on this programme. And just like Jens Stoltenberg there, saying the same thing, that the former president was right to point these things out, and we agree with him, and we're doing something about it.
We spoke with him when we were in Davos, and he said, honestly, he wasn't wrong. And frankly, it makes us stronger to also think internally about increasing our own defense spending, especially at a time of war.
Coming up in the third hour of Bloomberg Surveillance, here's the lineup for you. Keith Lerner of Truist, Bloomberg's Ed Ludlow, Mohamed, El-Erian of Queen's College, Cambridge, and Ashok Bhatia of Neuberger, Berman. From New York City, this is Bloomberg.
The markets are essentially priced for Fed perfection.
The market has already gotten to the point where you're likely to cut 2 times this year.
The concern is if they move too quickly, the expectational set in the market could get ahead of themselves.
I'm a little bit more cautious in the near term because I'm seeing evidence of investor over-optimism.
The most dangerous time for the economy is usually when the Federal Reserve decides they're going to help us.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
Line of the week goes to David Kelly. That was perfect. From New York City this morning. Good morning to all. The third hour of Bloomberg Surveillance begins right now. The rotation continues. Top of the pile, the small caps yesterday, again this morning. The Russell on top, advancing by around about 1.1%. On the small caps this morning. On the S&P 500, Lisa, going absolutely nowhere.
Which raises the question, how durable is this rotation? We were talking yesterday about a Goldilocks type of report, basically a two-pronged idea here of initial jobless claims coming in lower than expected and ongoing disinflation. Does that Goldilocks feel continue through the earnings cycle?
Earnings cycle continues on Wall Street, kicking off early this morning with JP Morgan and Wells Fargo. Just moments ago, Citi dropping. Sonali Basak alongside us to break that down. Sonali, what do you see?
Well, a few things here, John, as we watch for the rest of earnings to continue to cross the tape here. A few pieces that critically missed analyst estimates. That includes investment banking revenue, coming in below analyst estimates, and FICC sales and trading revenue coming in below analyst estimates, to a degree that we saw an even greater miss than what we saw at JP Morgan. Remember, JP Morgan just about met fixed income expectations. Citigroup meaningfully missed expectations on this figure here. Why is this important? We've been talking about it all morning. These Wall Street businesses are expected to rebound meaningfully. At Citigroup in particular, what we're watching for here is there's been a lot of change at the top ranks of a lot of these businesses. So perhaps they get some of a pass here. Remember, they're a new investment banking head, which they bought in from JP Morgan, just really started a matter of weeks ago. His pay package crossed the line just about 24 hours ago. And so a lot of questions here about how Jane Fraser brings in those businesses at this market, because of course, yes, we've had a rebound so far this year, but it has not been as robust as anyone would have expected.
Meanwhile, just looking through some of the numbers, their adjusted earnings per share beat the estimate. Yes, they did have a miss on the fixed income sales and trading revenue. They also had a slight miss on the investment banking revenue, but loans came in stronger than expected. Wealth revenue came in stronger than expected. Sonali, we got the three banks to really kick off earnings season. What are some of your takeaways? And I understand that it's early and you're still parsing through all the numbers, but is there a theme that has emerged in these three earnings reports?
Yes, you have investors here really, Lisa, banking on this idea that Wall Street businesses right now can save you from the weaknesses you're seeing in those key Main Street businesses. Even when you look at JP Morgan, which minted a record profit, you're looking at a lot of their net interest income from consumers coming in from credit cards. The big question about credit cards is, can the consumer keep maxing out on credit cards? Over at Citigroup, to your point here, it's a really strong sign that you are seeing strength still in the wealth management business, because you have the banks here leaning on their wealthy consumers in particular here to drive that extra dollar when you think about net interest income and the ability to lend to clients. But you are still seeing a lot of broad concerns here across the banks about credit quality at this part in the cycle. Even if it's not really extreme, you are seeing those numbers starting to mount at these banks.
Sonali, great work as always. Looking forward to your coverage at the top of the hour, 9 o'clock Eastern Time. Look out for the programme led by Sonali Bassett going into the opening bell. If you are just joining us, had some numbers this morning from JP Morgan, Wells Fargo. Citi just dropped. Here's the price reaction to all of that. JP Morgan just about positive. Wells Fargo negative by close to 6%, Lisa. That is the loser of this morning. Looking ahead to next week, got Goldman on Monday, got Morgan Stanley and Bank of America on Tuesday.
Really interesting story here as I look at some of the price action. It is messy. It is early days. The idea that Wells Fargo is down as much as it is it because they missed net interest income, or is it, to Sonali's point, some concerns about the credit quality of loans? And I'm not just talking about consumer loans, but also commercial real estate. They did flag an increasing number of non-performing loans in that space. This kind of goes to the question that we really set the show up with, which is, at what point will the earnings season kind of fly in the face of this Goldilocks soft landing? Does it indicate either more strength than people are expecting that could reignite inflation, or less strength that might make it a less auspicious moment for some of these other more leveraged names?
There's a theme here in the last 24 hours in earnings, and I think you're right on top of it, Lisa. Coming up to explore that theme in the next hour or so, we'll catch up with Keith Lerner of Truist as tech stocks head lower over the last 24 hours. Bloomberg's Ed Ludlow as Tesla delays its longer-awaited robo-taxi event, and Mohamed El-Erian of Queen's College, Cambridge, reacting to the inflation data that we get in about 25 minutes, PPI, and responding to what we got yesterday on CPI. We begin with the big issue. Stocks snapping a 7-day winning streak yesterday as investors rotate out of big tech. Keith Lerner of Truist staying bullish, saying this: stocks are in a bull market that deserves the benefit of the doubt. Moreover, strong first halves tend to lead to further gains by year end, albeit with normal corrections along the way. Near term, we anticipate that stocks will trade in a choppier fashion, but still, the primary uptrend appears intact. Keith's with us for more. Keith, I want to build on what Lisa's been talking about. I think it's perfect. It's the way to think about things. Yesterday, we had some data that spoke to this Goldilocks optimistic, constructive view of things. We also had some earnings that said the opposite. And Keith, I'm wondering how you view things, both on the economic data side of things and through the lens of earnings in the last 24 hours.
Sure, and great to be with you all. Yeah, yesterday was an interesting day. We actually downgraded a tech in late June after upgrading it in November. And basically our view was that, after a 40% gain since we upgraded it, that things had gotten a little bit too stretched. And in July, we saw the tech sector continue to kind of grind higher. On the other side, what we saw on this kind of mean reversion trade, the road band just got too stretched. The relative performance of small caps up until yesterday was at on a 6-month basis, was at the greatest underperformance we've seen since 2000. It was a 20% underperformance over 6 months. It's incredible. The average stock, the eco-weighted index, also had the greatest underperformance on a 6-month basis since 2000. So I think what we're seeing right now, what happened yesterday, Jonathan, is the road band got too stretched, and basically a little bit of good news went a long way for the other stocks. We got that broadening that everyone's looking for, but when that broadening is happening, those big cap tech stocks came in, and the market below the surface was strong, but the headline index was weak. So it's kind of interesting in the way this kind of played out.
I have this image in my head of kids in a rubber band fight, stretching it out and waiting to kind of let go. The letting go yesterday was the potential for rate cuts on this sort of Goldilocks-like kind of environment. At what point do you start to get concerned that maybe it's still not threading the needle perfectly, that some of the guidance that we've heard from banks, from other companies that have reported earnings so far, it is early days, signals something else that might portend a bit more weakness?
Well, I do think we are seeing a cooling of the economy. We wouldn't call it weak. And I expect that, earnings will be fine, probably not the blowout that we've seen in the past, but enough to continue to move the market forward by the end of the year. Forward earning estimates continue to grind higher. And I will say, I think one lesson during this, whole period we've seen the last couple of years is don't underestimate corporations' resiliency around profits, right? We had this once in a generation pandemic and inflation backdrop, and we've seen corporations handle that, pretty well. So again, I do think we'll be in a little bit more of a choppier fashion here near term, but I do think the underlying trend for the market is still higher, and the economy is just moving more towards a trend growth from this really post-pandemic stimulus, boom that we had. That's behind us now.
Let's talk about some of the areas where we're seeing a broadening. Smaller banks, for example, which has been one of the most beaten up areas. And we saw some gains yesterday. As we get some of the bank earnings from some of the behemoths, JP Morgan, Wells Fargo, and Citi, is there a takeaway that makes you more positive, more constructive, just in general in the financial sector?
Yeah, I think timeframes matter, right? So longer term, we still actually like tech on a longer term basis, and we think there'll be an opportunity to redeploy there. On a shorter term basis, I just think that areas like the financials, even the smaller financials, along with some of the industrials, even places like the REITs will likely outperform because the expectations are so low. So I think right now, I think we should be thinking more about how things are coming in relative to expectations. I think some of these areas that have been beaten up where, the small cap index, S&P small cap index was actually negative for the year up until yesterday, that the expectations are low. I think when you think about the tech side, I think expectations there are a little bit higher. So I think we're going to have maybe more of that bifurcation during this earnings season.
Keith, give us some clarity on financials. Not exactly left for dead. Bank of America's up 24% year to date. Goldman's up 24%. Citi's up 27%, close to 28% before today's moves, granted. Keith, are you talking more specifically about the smaller players, the regionals, the mid-sized lenders?
Yeah, that's right. Yeah, I'm sorry. Yeah, that's right, Jonathan. I mean, what's interesting was like yesterday during that big rebound, the big banks were actually down because what we've seen, it wasn't just tech. It was this gravitational towards the highest quality companies in the different sectors. So not just tech. So what you saw yesterday is the smaller banks actually outperformed and the other ones came in a bit. I think we'll see more of that just because of that divergence. Again, longer term, as we move past this kind of snapping back of the rubber band, which I think could last, weeks, if not a few months, I think the rotation will go back towards these larger quality companies. I just think it got overdone as far as just the quality theme on a very short-term basis. And we're going to see more of that unwind because positioning has further to go based on our work.
Got it. Keith, thank you, sir. Keith Lerner of Truist on the latest in this market and what we're calling the everything else rally of the last 24 hours.
I was very bad at rubber band fights. So when people start talking about a stretch rubber band...
Is that a thing? You used to do that at school?
Oh, yeah. At home, at school. Absolutely. You've never been engaged to that where you have to get it just so. I would always release
to put things on it.
Like a slingshot. No, I would always kind of get it wrong and it would fling back at me and then I'd feel really embarrassed.
Were you that person in the class?
No, never.
All right, OK, let's leave that there. Let's give you an update on stories elsewhere. I've just got that vision now. You bullied, Bremo? We can talk about this.
By myself,
by
evidently.
Yourself? OK. Here's your Bloomberg Brief with Neuberger. Hey, Danny.
Hey, John. Just a roundup of the earnings this morning from the bank. Citigroup reported earnings that beat estimates. FICC sales and trading revenue, however, did fall short of Wall Street estimates. For JP Morgan, it had record profit, including a 50% jump in investment banking fees, 21% jump in equity trading revenue to near $3 billion. Over at Wells Fargo, it was a net interest income that missed analyst estimates, falling to its lowest level in 2 years, but it did reaffirm its view for the full year. Another airline reporting a gloomy view for the summer travel period. This time, Germany's Lufthansa has cut its profit outlook for the full year. It said breaking even will be increasingly challenging with higher unit costs and falling ticket prices. It was yesterday, Thursday, that Delta warned that it's struggling to fill planes, resulting in a fare war that's dragging down ticket prices and weighing on profits. Donald Trump is looking for another win in his court cases. The former president asked a New York judge to toss out his hush money conviction in response to the Supreme Court's ruling that presidents have some immunity from criminal charges. Trump's lawyer claims that some of the evidence used in the case shouldn't have been allowed under the new standards set by the SCOTUS decision. Manhattan's district attorney has until July 24th to respond to Trump's motion. And that's your brief. John.
Danny, thank you. More from Danny in about 30 minutes' time. Up next on the programme, the Morning Calls, plus we'll catch up with Bloomberg's Ed Ludlow, reporting that Tesla is postponing its highly anticipated robo-taxi unveiling. The team behind that big move in the last 24 hours. Up next. Counting you down to the opening bell at 1 hour and 15 minutes away. Equity futures just about unchanged on the S&P 500. But as we've highlighted throughout this morning and through the whole of yesterday, the outperformance from the small caps, and it continues going into the weekend. Let's get you some morning calls with one stock very much in focus. It's Tesla. First up, Citi raising its price target to 274, keeping a neutral rating on the shares. The firm saying it's not inclined to chase the stock, even as it highlights a second quarter delivery beat. We're down again this morning. We're off by 2%. Your second call from Mizuho raising its price target on the EV maker to 230, also maintaining a neutral rating. The analyst Vijay Rakesh noting better than expected June vehicle deliveries, but says the company's focus on new markets with humanoid robots and robotaxis could be much more difficult to pursue. And finally, UBS downgrading Tesla to sell, but raising its price target to 197. The analyst citing concerns that shares have risen too much too soon on optimism over the company's AI plans, adding that any waning market enthusiasm for AI could impact Tesla's multiple. The stock in focus yesterday after this move, the stock was lower at the close by 8.4%, the biggest one-day drop going all the way back to the first month of 2024 off the back of this headline right here, that the company is planning to delay robotaxi unveiling to October from August. The man behind the story, Ed Ludlow, joins us now for more. Ed, it's great to catch up, sir. Thanks for waking up early for us on the West Coast. Just walk us through what you and the team have been learning about what's happening here.
Yeah, I mean, it's a delay of 2 months. You know, we were expecting a robotaxi unveil on August 8th because Elon Musk had posted on X that it would be August 8th. And what sources told us is literally in the last 48 hours or so, teams within Tesla have been directed that the delay to October is because they need more time. They're just not ready. They want to have more to show at this big reveal, more prototypes. One source told me that literally on Wednesday, the design team was told by Elon Musk to kind of rethink the design of this purpose-built robotaxi. So the market reaction is super interesting. You have to give the context of the huge run-up that had happened or preceded it. But I think there's a lot of anxiety that they've probably not made as much progress on a purpose-built robotaxi or Uber-like service as we'd thought.
So, Ed, a couple of issues to work through here. Let's just sort of work backwards if we can and then work forwards. So this wasn't just about the carrot over the stock, the robotaxi business. They were also doing better on deliveries, better than we expected as well. Can we talk about the run-up into this news story that you and the team put out and what was behind it? Because we heard from some prominent investors, including Bill Gross, the founder of PIMCO, who said that Tesla had become some kind of meme stock. And this didn't make sense. It was divorced from fundamentals. What did you think of the rally before we get into the sell-off of yesterday?
Yeah, I mean, there's certainly a tension between a large body of sort of legacy Wall Street institutional investors who have to trade on fundamentals and consider long-term as well that Tesla's in the business of manufacturing and delivering electric vehicles to consumers, though that tension is against a large body of both retail and other institutional investors who say it's just going in the future to be a negligible part of the bigger pie and that the rest of the pie will be software or selling a service. And the eagle-eyed of the audience who watched the Tesla AGM video, and this kind of ties together the last 24 hours, will have seen a very short video clip where a Tesla employee demos an app very similar to Uber's app, where they have a ride-hailing type service. And one interesting thing I'd note is don't just look at Tesla falling yesterday. Look at the two stocks that jumped, and they were Uber and Lyft, both up 5% in the session. And I think it's this idea that, you know, Tesla stakes its future on the idea that it's going to operate a fleet on behalf of a ride-hailing community, and we're just not there yet.
There are a lot of institutional investors who also, though, are betting not on the fundamentals, but are betting on the idea of a brilliant and volatile founder who has big ideas. And Tesla is going to be the showcase for them. The reason why maybe your scoop, your story really hit hard is this idea that maybe this is a company over its skis with respect to what it's promising. Is that what you gathered from this delay, that they weren't able to accomplish the highfalutin goals that they had set out for that would distinguish them from just being a car company?
I actually have like a bit of relief that you've asked that question. And the reason being is, first off, Bloomberg stands by its reporting. And every time we report something like this, we spend time on it, guys. You know, the people that we speak to inside the company We do so thoroughly and carefully. But of course, we also write to Elon Musk. And in my career so far, I've never seen a reaction like the one overnight. It started with Bloomberg cannot possibly be right about this. We're talking about just a 2-month delay, right? And they're all calling out to Elon on social media. Elon, please tell us what's going on. Tell us the truth. And he didn't comment on the story, right? He hasn't posted on X. And I've written to him multiple times in the last 24 hours and said, do you want to talk about this? But they all pin the idea that this is a vision he owns. And his vision for the future of the company, which he codifies from time to time through a document he calls the master plan, has evolved. But this is the problem with investor relations at this company. It's all funneled through him and his personal use of his social media account. And so whether you're an institutional investor or a retail investor that has different rationale for wanting to hold the stock or own the stock, it's incredibly difficult because the information pipeline officially from the company just isn't there.
Well, thank you for doing what you do, and it is wonderful to get some insight on this. I'm wondering, as you were carefully reporting this out, did you get a sense of why there was this delay? Was it simply they didn't have the time frame to really test the technology and get it perfectly down pat? Or was it just that there were some fundamental issues that have plagued every company that has tried to come out with some sort of robo-taxi or an automated car and frankly faces off with different types of testing and regulations, but also just technical challenges?
Yeah, we've certainly had the sense that some staff at Tesla are a little bit caught off guard in the week of first quarter earnings earlier this year. You'll remember there was that original Reuters report that Tesla had scrapped a plan for a $25,000 EV consumer car to pivot to a robotaxi specifically. And what Dana and I did that week was kind of clarify the situation that it's more complicated than that. They're working on sort of engineering the cost down of their consumer cars while being focused on a robotaxi. Again, the two specifics we reported 24 hours ago or so were that they didn't have much to show, or they wanted more prototypes, more physical things to unveil in October. But also, Elon appears not to be happy with whatever it is that they currently had to show, because the design team's been asked to think again on what it looks like. And again, go back and if you're interested in Tesla, go and read the master plan documents on the website. The origin of this robotaxi plan was that you took a consumer car with all the bells and whistles to make it drive itself. And when your lease was over, you gave it back to Tesla, and that made up its fleet. And that evolved to you being able to opt in to an Airbnb-style platform where if you're not using your car, you list it on Tesla's platform, and off it goes in the morning, drives itself to be a robotaxi. The purpose-built robotaxi is a more recent iteration of the plan. And what Tesla and Elon Musk outlined at the AGM is that it's going to be a combination of all three. And I'll just end by saying, as you guys know very well, Elon Musk often misses his own deadlines and the timelines that he's outlined, but he does often get there in the end. And I think that accounts for a lot of the confusion and panic we saw on social media in particular, but the severity of the decline in the stock in yesterday's session.
The stock is down again this morning by 2% at the pre-market. Ed, before you go, I think we all wanted to give you some space to talk about your column, Hyperdrive. Within that, you've talked about Rivian as well. You've outlined what's going on with Tesla. What is happening with Rivian?
Thank you, John. Well, I reported in a 4,000-word Business Week story yesterday about Rivian's latest plan. But there was a bit in it that I didn't want to be missed, which is, according to my sources, Rivian applied to the DOE for some loans made available through the Inflation Reduction Act. And the DOE said, sure, you can have the loans if you change your stance on unions in the state of Georgia. Rivian, just like Tesla, is not going to, welcome unions. They don't believe it's the right approach. But I think it's so interesting in this presidential election year, the DOE's function. It's been emboldened by Biden to and Biden last night spoke about his stance on unions and labor right very clearly. But what happens if Trump takes the presidency? Because remember, in his first term, the DOE was almost in that department, loans for EV programs, almost sort of thinned out, ground down to a very small group and entity. So, read the column, but I think there's an interesting situation here about what happens to the money made available in the through the Inflation Reduction Act and how it's given out, especially in the context of the news yesterday of more money from the Biden administration to retrofit or convert closed down plants that were building gas cars.
Great work, Ed. Very cool. I'll look out for that. I just want to squeeze in one more question. Let's just say you're living in New York, you don't have a driving license, and maybe you want to use that robo-taxi that you just described. Do you need a driver's license for that, Ed? Can I just sign up, get a subscription?
I think that's an excellent question. I honestly don't know the answer. But I guess that the bigger question is liability and insurance. You always ask the question, would you put your kids in a vehicle that can drive itself? But I guess in your case, John, or my case, like, would I get in and who's in control of this? We don't even know what the robotaxi looks like or the specs of it. So I'll promise you I'll go away and find the answer, but I just don't know.
I'd love to know. I've been thinking about that for ages. Eduardo, thank you. As I explore maybe getting a driver's license for New York.
That's what I was going to say.
Just sort of waiting.
The bigger question is, why don't you have a driver's license?
I just think, maybe we're a few months away from the robotaxi and I won't need one.
Okay, so that's the reason why?
Yeah, and then I'll sign up.
It's a bet on the robotaxis?
It's the reason why.
Okay.
And I stand by my
right.
statement, okay? PPI's up next. PPI data just around the corner following CPI yesterday. The data's about 20 seconds away. Here are the scores going into it. In the equity market on the S&P 500, unchanged. The outperformance on the small caps were up by more than 1 full percentage point after a monster rally yesterday, encouraged by the economic data. Will it get more encouragement in just a moment when this data drops? In the bond market going into it, the scores on a 2-year, yields just a little lower by 2 basis points. Adding to the move yesterday, your 2-year 4.4892. Here's the data, a little bit hotter than expected on PPI final demand month over month at 0.2%, the survey 0.1. Stripping out food and energy, month over month we come in at 0.4. That's an upside surprise in our survey. The number, Lisa, 0.2. Just a little bit hotter in those first two reads.
Especially when you strip out energy and food. As you were mentioning, we also have, of course, year over year. That means it's substantially higher. When you take out food and energy year over year, PPI comes in at about 3% versus the estimate of 2.5%. This goes into the GDP print. This goes into some assumptions that people look at. But typically people weight CPI more significantly. I am wondering, though, how much this sort of dampens the enthusiasm we got yesterday.
Can I tell you, I think the market reaction is more important than the economic data.
Agreed.
Or rather, more interesting, if I can put it that way. Look at the Russell, it was up by more than 1%, up just 0.5% now. Look at the bonds. Look at the 2-year, front end of the curve, treasuries. Yields were lower by a couple of basis points, yields are higher by a single basis point. That's a turnaround, up by almost 2, 4.52.92. And we'll be asking a question, Lisa, are we getting too carried away off the back of one set of economic data from yesterday?
The inflation beast hasn't necessarily been killed, and I think that that's what people are sort of reconciling. It won't be this easy path to a September rate cut by the Federal Reserve. Whether we see this stick will be interesting. I do wonder how leveraged this broadening out trade is to this idea of an imminent rate cut. And if we don't get that, how much of a reversal back to what we had previously. I also wonder, PPI is sort of an interesting measure because people previously didn't put that much energy on it. They think, okay, CPI is the main one. And yet this has been enough to take a lot of the wind out of the sails.
Just a little bit. Anyway, on the margin, dollar yen back through 159, just briefly off the back of this as well. If you are just joining us then, a little upside surprise. We come in at 0.2% on PPI. Final demand month over month. The estimate in our survey was 0.1. Upward revision as well to the previous month. You're seeing that stripping out food and energy too. Coming in at 0.4%. The survey, Lisa, 0.2.
Yeah, and final demand. This is interesting. The revisions, again, are interesting. Revised to flat, basically, on the prior month versus the initially reported down 0.2%. The revisions have been inconvenient. I just want to note that and sit on that, whether it's jobs or whether it's inflation. Jobs picture looks worse when the data gets reflected. Inflation looks stickier when that data gets reflected, which just raises this question, how much are we banking on the soft landing Goldilocks scenario a bit more than otherwise assumed?
I think a lot of people banking on yesterday continuing. You could see it across the board on the south side yesterday. Andrew Hoddenhorst of Citi just put out a note. I'll share it with you in a moment. He said yesterday, call CPI cements upcoming cuts. JP Morgan's Mike Feroli brought forward their call for the first rate cut, I think from November to September, saying sticky inflation is coming unglued. Bank of America's Michael Gapin, more good data. The sequence of things for Andrew Hoddenhorst, that note just dropped from Citi. This is what they look for now. We expect a strong signal in July that cuts will begin at an upcoming meeting. Jackson Hole in late August is an opportunity to confirm not only the September cut. This is the call from Citi. This will also be the first in a series of steps to reduce policy rates.
And it is early days, but right now, based on Fed funds futures, you're looking at a 98% chance being priced in of a September rate cut. We'll see whether that gets readjusted. The point being, people seem to be coalescing around this. And this data that we just got seems to be a bit of a fly in the ointment.
To respond to the data we just got and the data we've had over the last few weeks, I'm really pleased to say that a good friend of ours on this programme joins us now. Mohamed, El-Erian of Bloomberg Opinion and of Queen's College, Cambridge. Mohamed, wonderful to end the week with you, sir. Let's just work through this economic data we got this morning and the data yesterday as well. When you look at the totality of the data, what kind of conclusions are you drawing currently?
So I have two conclusions when you look at the totality of the data. One is based mostly on the CPI, which is that what we're seeing is demand destruction and a loss of pricing power. When Mike McKee commented on it yesterday, he said it's very broad-based, benign inflation numbers. And you're really starting to see the demand destruction and the loss of pricing power. And that's consistent with what we've heard from companies, and it will be consistent with what we will hear from companies next week and the week after. And it is also consistent with the macro data that's starting to weaken. So that's conclusion number one. Conclusion number two is on the cost side. We're living in a global economy that, despite China's deflationary impact, is not giving us the sort of deflation that we'd like. On the PPI, the supply side simply isn't there to help what's happening on the demand destruction, which is going to force something that you don't like me talking about, but I will, that there'll be a lot more discussion as to what's the right inflation target, given that the dual mandate. So I expect the Fed to focus much more going forward on the two-sided risks, and within that, much more on the employment side of those risks.
You brought it up, so let's talk about it, and then we can talk about the labour market. Mohamed, the right inflation target. The question that the chairman's been asking for a while, and he talked about it in his testimony twice this week. It's their question. Are we on a sustainable path back to 2%? Do we need more confidence? And he said repeatedly we need more confidence. If some officials start to say that they believe they are confident we're on a sustainable path back to 2%, not 2 point something, not 2.5, not around 3, but 2%, why would you caution them? How are you thinking about the world differently? Why do you think that's going to be so difficult?
So if they just say we're on the path to 2% and leave it wide open as to when we're going to get there, already the chair has said we won't get there in 24, we probably won't get there in 25. If they leave it wide open, I'm fine with that. If, however, they feel that they need to deliver the 2% either this year or next year, I would worry as to all the undue losses to output. I would worry about the employment side as well. John, the only thing keeping segments of the household sector, the lower income one, and the small business going, the only thing keeping those going is labor income. And if we lose labor income, we no longer have the balance sheet strength that we had before, and it will result in a much, much stronger decline in demand.
Mohamed, what you're saying is fascinating at a time where Steve Rasciuto yesterday came on of Mizuho and said his fear is you are seeing companies lose pricing power, as we saw from Delta and Pepsi, at the same time that supply side inflation is still present. His worry is that leads to margin compression now. If the Fed cuts rates, they'll be able to pass along those price increases to consumers. Inflation will go higher from here. Why is that a preferable outcome in your view?
So I listened to him, and the only question I asked myself is, what about the lags? What about the lags? It's not going to happen instantaneously. In fact, we still have the lagged effects of one of the most concentrating hiking cycles in history. So the lags right now are working the other way. So it doesn't work instantaneously. That's not how monetary policy works.
So when you talk about the labor market, and let's go there, because yesterday we got a good sign in terms of initial jobless claims and how much they actually came down below expectations. Why are you looking through that as an anomaly, a blip, rather than a sign of strength underpinning the economy?
So you said earlier, how much should we conclude from a data that's every month? How about every week? The jobless claims data is inherently noisy. If you were to take a moving average of 3 months, 6 months, there is absolutely no doubt that you will see that indicator is not as strong as it was before. Now, from week to week, it will differ enormously because it is noisy data.
At this point, when you talk about we should really be thinking about what the right inflation target is, what's the correct balance between inflation target and employment at a time where we're talking about something like 4.1% on unemployment and you're talking about inflation of 2%?
Yeah, and it's this notion of undue damage to employment and to the economy. There's also a very important distributional effect here. So it's pretty easy now because the Fed told us that they expect unemployment at 4%. We are above that number in June, and we're likely to go even higher than 4.1%. So already that part of the mandate is flashing yellow. Meanwhile, the other part of the mandate, even though the chair didn't call it as such this week, but did call it last week, the disinflationary trend is continuing. The big question is disinflationary trend to where and at what time. I think the Fed will keep this wide open. They'll keep on saying 2% is our target. We'll get there when we get there. They're not going to sort of be very precise as to when they're going to get there. And they're going to wait and see how the economy accommodates. And that's the way of doing slightly higher inflation targeting without calling it that.
If you are just joining us, welcome to the programme. Lucky to have with us Mohamed, El-Erian. Moments after we got PPI data, I want to go through some of that data for you, coming in a little bit hotter than expected. Going into that print, the Russell of small caps was up again by something like 1%, faded off the back of it, then started to climb again. We're positive again by 0.75%. If you switch up the board and turn to the bond market, going into the number, yields were lower at the front end by a couple of basis points. We've erased some of that move. We're just about unchanged now in the session at about 450.82. Not major moves, Mohamed, but they're the moves of the last 10 minutes or so. You said something interesting, many things in fact, but I want to pinpoint just one. And you said the labour market was starting to flash yellow. When you hear from the Fed chair, he describes the labour market as being strong and a reason to get this right. You've said before that this Fed should be thinking about moving in July, not waiting until September. What is a couple of months between friends? Why do you think it is important to start getting going and getting moving earlier and sooner rather than later?
If I was as certain as the market is that he was going to move in September, I will tell you that a couple of months, there wasn't much in it. However, you have two factors that may complicate a September cut for this Fed. And I want to stress for this Fed. One is they may get one bad data point. And then because they're so overly data dependent and they're not looking forward enough, that could postpone the first cut to November. And then you're starting to talk about a longer lag. The second issue is the politics, John, is what does the politics look like when we get to September? And how worried are they that there's going to be an inflationary shock coming after the elections due to policies? So it's not as simple as saying, well, the market thinks it's over 80% probability is going to happen, because this Fed is very impacted by high frequency indicators.
Let's flip this on its head, because a number of guests have come on the show and said that the big fear for the Fed and the worst case outcome would be if they had to reverse course and hike rates again at some point in response to an inflationary shock. Do you think that isn't that big of a risk, or it wouldn't be that problematic if they had to reverse course, say next year, after starting cutting either in July or September?
So I do agree it's their biggest fear. They don't want to be in any way resemble to the 1970s. And it is a huge fear. And they've already made two mistakes in the last 3 years. First, a transitory call that was horribly wrong. And then secondly, at the end of last quarter, they got too excited about what was happening on the inflation numbers, and they had to reverse their view. And we saw the amount of pivots. I've never seen so many pivots in forward guidance. The whole point of forward guidance is to provide smooth market adjustments. Instead, we've had this enormous number of pivots in the signals from the Fed. So I understand that hesitation, and I agree that this will be in the back of their mind. If they do have to hike next year, I think it's a low probability. But if they do have to hike, it is because something has happened either externally we've had a major shock somewhere, or the policies elsewhere, fiscal, trade, have fundamentally changed. And I think people will understand that, and they won't blame the Fed. They'll see that there's something else that has happened elsewhere. No one blamed the Bank of England when it had to respond to the Liz Truss moment. I don't want to say the US is going to have a Liz Truss moment. It will not. But people understand the credibility of an institution when the shock to inflation is coming from outside.
Mohamed, final question. Do you have more confidence, more faith in Chairman Powell's Federal Reserve or Gareth Southgate's England team?
Well, that's a really, really tough question, John. And I think, at every interview, you get very close to the line, as Paul McCulley used to say, that separates courage from stupidity. I think I'm going to stay on the right side of that line.
Mohamed, it's good to catch up. It's a lot loaded in that response. Mohamed El-Erian there, the brilliant Mohamed El-Erian from Queen's College, Cambridge. A lot to say there, but particularly on the Federal Reserve, this idea that if they go in September, great. This is Mohamed's view. If they go in September, great, but don't take it for granted that they're going to go in September. Things could change. And he said this a few times. He's characterised this Federal Reserve as being hypersensitive to incoming information. And it might take only one data point to put them off hiking.
If you think Well, I mean, if you think about the rhetoric that we've heard, the idea from Austin Goolsbee, this was it. This was what we needed to be confident. And then you get PPI, and there's this idea that the inflation beast, at least on the supply side, isn't killed. If they do wait till September, does politics start to bleed in just a bit?
Long week, I'm confusing hikes with cuts. Forgive me. This line just came in from Chris Harvey of Wells Fargo. Here's a quote for you. Given the price action we've seen over the last day or so, we believe the great rotation needs lower rates and earnings optimism. CPI delivered the lower rates. Earnings concerns linger after Delta. This was your point.
Well, this to me might be the bigger takeaway. The data is noisy. Earnings are less so if you have some sort of overarching real consensus. We have seen those concerns about not being able to price along pricing. There's now also concerns about credit quality among the financial institutions. That might speak louder, to me anyway, than anything else.
It's been quite a week, hasn't it? Let's get you an update on stories elsewhere this morning. Quite a morning. Here's your Bloomberg brief with Danny Berger. Hey, Danny.
Hey, John. At least 3 new Democratic lawmakers are now calling on President Biden to step aside after his news conference last night, where Biden made 2 major gaffes in about 2 hours. First, referring to Ukrainian President Zelensky as Putin, and then calling his Vice President Trump rather than Harris. The president now prepares for an interview on Monday with NBC's Lester Holt. And more trouble for Boeing, warning some 737 MAX customers that deliveries could be further delayed in 2025 and 26. Sources tell us that the plane maker said timelines may slip by 3 to 6 months on top of already late handovers. A Boeing spokeswoman declined to comment, noting that the company is in a quiet period ahead of its July 31st earnings release. AT&T suffered a massive hack of customer data. It was one of the biggest breaches of private communications data in recent memory. The hack included records of calls and texts for nearly all of its mobile phone users for a 6-month period in 2022. The company said in a regulatory filing that the breach also included records from customers of wireless service providers that use AT&T's network between May 1st and October 31st of 2022. And that is your brief. John.
Danny, thank you. Thanks for this morning. We'll catch up on Monday. Up next on the programme, setting you up for the day ahead. You're watching Bloomberg Surveillance. Counting you down to the opening bell, here's the lineup for next week. What a lineup we've got. On Monday, the Republican National Convention begins. We'll also get Fed speak from Chairman Powell himself at 9 p.m. Eastern Time. NBC anchor Lester Holt will interview President Biden. That's must-watch TV. Tuesday, we'll get retail sales and a ton more Fed speak. Including on Wednesday, we'll hear from Barkin and Waller, plus the Fed's beige book. On Thursday, another round of jobless claims, and we round out the week on Friday with more Fed speak from Williams and Bostic. Joining us now to wrap up the week and look ahead to next week is Ashok Bhatia of Neuberger, Berman. Ashok, wonderful to catch up with you, sir. I just want to understand from your perspective, is this a week where you put more weight on the data, which was good, or the earnings, which haven't been great?
I think for the bond market, it is a little bit of a combination, but more the data. I mean, I think you take a quick step back after, strong first half of the year with, good payrolls and higher inflation rates. June and July have really brought deterioration in the job market and now a couple of soft inflation prints. And we think that's going to be the trend for the next few months. So from now until that September meeting, our estimate is we'll see continued softness in inflation and a little bit continued deterioration in the jobs market. And that leads to the Fed easing in September. I think the point you make is, though, there is softness in earnings. We've heard from some of the airlines, the consumer goods companies, and there's a lot of idiosyncratic things or stuff going on, but there is a bit of a theme that the consumer seems to be pulling back. And, our expectation is that'll be a continuing trend as well the next couple of months.
Which really tees up the question about the labour market. You're expecting some further softening. Can you help me understand what that's going to look like? I think yesterday, really people were empowered by this idea, not just that CPI was a bit softer than expected, it was that jobless claims dropped back as well. And they were empowered to go and buy other things like small caps, and you saw the price action, Ashok, yesterday. What is the kind of softening that you're expecting? Is it unemployment going from 4.1 to 4.5? Is it something worse than that? What is it?
Well, I think there's two things. I mean, the unemployment rate, right, has already been rising. So, we get another, 20, 30 basis points rise in the unemployment rate from here. That'll be about 100 basis points off the lows. So kind of, maybe not lost, but certainly underlying a lot of the job market data has been this gradual rise in the unemployment rate. But I think the biggest concern that we have about the job market is just the continued narrowing of where job gains are coming from. The last year and a half, right, we've seen layoffs and job deterioration in technology, finance, real estate. Really now, like you look at the private sector jobs markets, 60% of the jobs that have been created this year have been in two sectors, education services and healthcare. The last job print, that's continuing to narrow to primarily healthcare. And typically what you'll see in a labor market is at the late cycle, you see a narrowing of job gains. Those sectors then, reduce or stop hiring. And that leads to weakness in broad payrolls. And that's broadly what we're expecting. But, short answer to your question is the narrowing of job gains is our biggest concern there.
Especially at a time where we're seeing a number of companies talk about credit concerns and the loss of ability for consumers to keep spending and to keep on paying back their bills. How much do you think that has or has not been reflected in credit markets in particular?
Well, it's a really tricky one because, credit spreads, as we all know, like they're pretty low, pretty tight. High yield is just spending a lot of time around 300 basis points at the index level. And, IG spreads, remain sub 100. And these aren't the all-time lows, but they're closer to that than something else. And I think, the tricky part of this is that company balance sheets are generally in good shape. So they are in a position to weather moderate deterioration in the economy. You get into something more significant, that can be more of a fundamental risk for credit. But, the environment we see is that of how the macro will develop is that the impact will be more in the rates market and the central banks and the Fed and ECB, rather than something the deterioration is going to really show up in the credit markets. So credit's more about just dealing with these tight valuations rather than, there's a big fundamental story brewing in our view.
Interesting framing. Ashok, always love catching up with you. Learn something every time. Ashok Bhatia there of Neuberger Berman on this fixed income market. We've got to wrap up the week and look ahead to next week. Rhame, let's get over to Anne-Marie down in Washington, D.C. The Republican National Convention coming up next week. Another key interview as well, Anne-Marie, for the President of the United States on Monday.
That's right. He'll be sitting down with Lester Holt of NBC Monday in Austin, Texas. Today, he's going to be in Detroit, Michigan. He wants to make sure that he can sell his campaign to not just the American people, but the Democratic Party. 17 Democratic lawmakers have now come out and said he needs to step aside as the nominee. Politico put it this morning, really fantastic, saying Dems are living in purgatory now. Yesterday didn't do enough to assuage their concerns about President Biden, that performance, the fact that these gaffes completely overshadowed the policy and the substance of what we should have been talking about. Your point, Jonathan, earlier was right on target. There are 2 hot wars happening in the United States, and yet everyone in the room was wondering about President Biden's bedtime. They're worried about his health. Can he do this another 3-4 years? Can he go sit across the table of autocrats like Xi Jinping, Vladimir Putin? But yesterday, was it so bad the game is over for him? No. So he's still fighting his political life. So next week is going to be entirely focused on Biden, maybe potentially until we get to the RNC and we find out from President Trump, former president, who his VP pick is.
Lisa, this is the presidency. This is not just about the campaign. This is about serving as the president of the United States. This ridiculous game about whether we can get through an interview or a news conference. When are we going to stop playing this?
Well, a lot of people have been treating this like a, reality TV show for quite a while. And that's the reason why a lot of investors who sit around here say we look at the earnings of the companies because that's a little bit more reliable than some of the reality TV shows.
Perfect time to take a break. Guess who's taking a break next week?
I'm off.
Lisa's taking a week off. Bramo, enjoy yourself. Next week, here's the lineup. Monday, Steve Cheverone of Federated. We'll catch up with Matthew Bartlett of Derby Field Advisors, Jim Kerrin of Morgan Stanley, Stephanie Roth of Wolf Research. Have a wonderful weekend.